What's up, everybody? Good morning. Ready to go on FOMC day. Market's opening clean, rational. Things looking great. Y'all know how we do it. What's up, John? Good morning. Nice, clean, rational day. To pop up some red lines really quick on these NASDAQ and ES charts just so we can pay attention. We got some illiquidity coming through on Fed. So illiquidity pivots, first thing we got to make sure we do. Get a yellow line and green line, yellow line, red line chart for you guys today. All right. Good morning. All right, let's make those. Something you gotta do. Okay. I get that marked somewhere. My old catalyst. Okay, so that CPI catalyst is gone. That catalyst is gone. These are all. So what I'm doing right now is I'm making a I'm gonna make a red line chart. So I'm gonna get some pivots going just so I can mark up later. Catalyst, non-farms, catalyst, catalyst, catalyst. Okay, just pre-market prep right now. We're getting ready for FOMC, everybody. So just chill, chill. Oh, you talking about my tweet, Garrett? Don't call my strats tricks. Oh, yeah. What is it? Illusions, Michael. You ever watch Arrested Development? Nice trick, Job. Yeah, no problem, man. That's something we need to do anyways for next couple of hours. You know, leading into FOMC, there's not, you know, you don't do a lot of, you maybe a scalp in the first hour or two. I mean, you're out of the way, and FOMC is going to have that illiquidity coming through. You know, I'm expecting 25 basis points today, so that's been my expectation for a while. It's a non-farm, not a catalyst anymore. So you're going to mark up some of these. I agree, dude. I know. I wish I was good at selling stuff. I'm horrible. I'm a nerdy mathematician. I forget that there's an art form just selling. Although I'm pretty good at magic tricks. I had a magic trick that I had when I was a kid. My dad told me one. He said, "Don't ever tell anybody that there's no power in telling people how a trick works. Nobody wants to know how it works. Once you tell them, then they no longer want you." So I had this card trick that's like always impressive, even in my 40s. And I handed it off to one of Nicole's little nieces, and I told her the same thing. She was 9, and I go, "This is your trick. Show everybody, but don't tell them how it works, and guard it with your life." Let's see. Make another. I'm just kind of marking, seeing if I can find some generic spots to kind of test in a second. Simple tips all day long. Yeah, here's the trick of FOMC. You just don't trade in the first 30 minutes. What I love is how that trick, that tip, that's something that has made its way through the echo chambers. I'm hearing a lot of people reiterate that. I remember the first time I went on Spaces about a year ago, over a year ago. There's a lot, like Spaces just kind of brought a lot of traders together, right? That had never met each other before. And the style of like, don't trade in the first 30 minutes until the press conference was something that we've always done, right? We've always been that way. And I'm glad to see that like even some of my really close friends have been like, you know, really, really, really good traders. And they're like, you know, I always tried to trade the FOMC until I met you, Matt. And I learned that you just sit out for the first 30 minutes and like, it's so much easier to not try to guess like how Wall Street perceives it. It's almost like we're really good at guessing what the rate decision is going to be. We almost always get it right. And we don't even look at the futures. We fundamentally guess, right, based on Powell tells you what he's going to do. Futures tend to converge with my thesis usually. The Fed funds futures. And then, you know, trying to guess if Wall Street's going to think of today, if we get 25 or 50 again, if Wall Street's going to find that to be a bearish or bullish thing, you will never know. And that's the thing. You may think it's a bullish or bearish thing, but it doesn't matter what you think. It's going to decide what I'm going to tell you. It's probably going to come through as 0.25. It's probably going to spike and then turn around and sell off. And that's what I'm expecting to see. I don't know if I'm going to try to short or fade one of those type of moves. That's why I'm going to try to get red lines up there above where price is trading now, so I can see those pivots. And I might actually take maybe a risky scalp short, since it's an illiquidity moment. It'll just be like a very small position, micro or two, you know, nothing crazy, because you don't want to risk a lot when you know the move is going to be big, and you're gambling or you're flipping, especially shorting against a pivot, something you almost never do unless it's a bear market, right? I would take and why do I believe it would sell off? Not because of any other reason other than we're still in earnings. There's a reason for the market to rally going into major earnings, which are literally today and tomorrow and early next week, right? We have Apple and Google and all the big ones coming up. So I'm just marking up. I'm doing one of my processes right now to kind of get prepared for the market day. We've got 15 minutes till we get started. I'm just marking what we call red lines. So this is a thing that we do and we teach, that we just have an illiquidity pivot. So when the market moves really rapidly, as of this day, you clear out these pivots, right? It's a really cool technique that we have. There's not really any to the downside, I'd say, other than the one I marked. And upside, I don't really see much that I haven't already marked. So we've still got some yellow lines in the vicinity. We've been ping-ponging between these two. This guy's been support. So today we're talking, you know, this area here. This is still that CPI catalyst. Now we have come through and touched it already. So let me go ahead and remove that. This is old. The catalyst sat here all day. So really downside 39.51 I see, and then upside there's nothing really, yellow lines. So we'll look for gap fills on the SPY as well. Let's do NQ really quick. And I'm gonna. Oh, I already did these yesterday. Okay, sweet. Let me write this down. What's up, you guys? Smash that like button real quick. 769 or 11649. Okay. I'm just going to go ahead and translate these over to the new. I did these yesterday, but I did them on the wrong chart. 11,649. Hold on. $11,769. Okay. Welcome to Rock Scooter, everybody. Welcome to the stream. Glad to see you all here. We're just getting pre-prepped for FOMC. These are some tricks that I do to get things situated. Okay, so just having some downward targets. So actually we do have on NASDAQ a very closer 11,920-ish level. I'm going to zoom out here. So 5-day streak. Maybe today. I'm in a 4-day trade streak. You know, up like 8 or 9% on the small account just in the first week alone. We scale the positions like the way that I do it is we're gonna get ready to mark our catalysts as well when we get there. I trade a % of the total account, especially for futures, relative to the net look of the account. So right now my max position size is 10. Or 1 mini, 10 micros, and as they get bigger, it gets bigger. And so the gains in the first start of the trading challenge is usually like in the $500 range per day. Every $10,000, it's $1,000 a day. So like when we're at the 50K mark, it's going to be up and down, you know, $5,000 a day. So it starts to ramp up pretty quick. These challenges, depending on how the market is, these non-volatile, flat, choppy markets are quite simple, like compared to like sell-off markets or even rallying markets. Like these kind of markets are very easy to trade. You may not think so, but these are my favorite markets to trade. Markets just slowly edging bullish with big dips and big ups. These are my favorite because you have a lot of clear signs. Irrational market, don't trade. Irrational market, don't trade. So I sat out, I traded. I sat out, I traded. Today I'm gonna be trading, right? We're gonna have a DD, positive DD. I might be looking for a dip to rally to here. I'm gonna be careful if we lose the irrational levels here, 12.34. So in FOMC, you have to make sure that you're really closely paying attention to these illiquidity pivots because the market will become illiquid during an event. Oh yeah. Oh yeah, the like button is free, guys. Give it a smash. Smash it up. All right, so looking for plays today. Let's just kind of talk about pre-market. We always have to make sure we're paying attention to that. Everybody, make sure if you haven't grabbed your liquidity map, grab it from the Discord. Let me give you a little cheat sheet here so you can follow along. The effort and training vids are very much appreciated. Thank you so much. Appreciate you. Appreciate the work you're putting in this every day. Like I'm having meetings about how to make the learning fun, easier, you know, like reading Rainbow style. I love that show. That means we need a theme song, don't we? 10 MES the same as 1 ES. Personally start off with MES. Yeah, that's how I do too. So I take, if the contract size on my position is my max size I'm willing to risk. So typically most trades I have 2 entries, maybe 3 sometimes, but usually 2. So the rule is, if say that the contract margin is $10,000 per contract, not from your broker, but from the CME group, the performance bond minimum, you set that number, say it's 10,000 for a mini, which means it's 1,000 for a micro, and I have 10,000 in the account. Then I take 10,000 divided by 1,000 equals 10. That's how I do my position size. So I stage up so that when the account gets bigger, my allowable max position gets bigger. Where's my trading account? Oh, hold on. Hang tight 1 second. Let's open this up. Enable 2-step verification. I need to go ahead and do that at some point. So it looks like, I think when NinjaTrader and Tradeovate are still in the process of merging, I know Tradeovate was a non-clearing FCM, and I guess, I think I remember reading something that Tradeovate, or that NinjaTrader is now their own clearing firm. So that's probably where that merging comes from. That's probably why I have a different account number, because it's no longer with Dorman, who was the clearing firm for Tradeovate when they were non-clearing. So I don't know where they are in the merger right now, but I'm assuming that's what's going on. If anybody has the history, futures, if you ever do anything in futures, this is a very complicated world. There's a lot to learn how it all works. Good morning. What's up, Alpha Labs? Good morning. I'm assuming I need to go check though. right, team. Good morning. Will market again be mean reverting? You know, it's FOMC and things are kind of moving higher. So I think that we'll probably get something similar. Everybody make sure you grab your liquidity maps. Smash that like button. That's the freest part of Rocket Scooter. Let's take a look today. Effective funds rate, 4.3%. Versus 4, yada, yada, yada. Let's see on the news. Treasury stuff. Equity market's doing okay. Asia market wrap up. So we have labor data coming out Thursday to keep in mind that I'll show you guys all the important news you need to pay attention to. We have the ADP numbers today, right? Which means typically it means Friday. We should have the let's see, ISM is Friday. Okay. Is that Friday? No, that's Thursday. Wednesday. Oh, there it is. I was like, that's not Friday. Let's get back here. Non-farms will be Friday. So ADP today, non-farms Friday. Jolts, right? Coming up today. There's a big day. So this is all the inflation stuff is going to come from today. We have FOMC, right? Jolts and wages are the two things that are causing inflation, right? So jolts are the number of job openings. If fewer job openings, it means that wages will come down. People are competing more for the one job. You have more people laid off. It also means wages come down for the same amount of job openings. So the two together are very important metrics to predict where inflation is going to be. If you can predict where inflation is going to be, every single month you can predict what the Fed's going to do. And so the job openings have been coming down and coming down and coming down because we're laying off, 5% of the workforce over the last year, 10%, some companies even higher. And now in this environment, it's stabilizing. You laid off all the holiday work, right? After you get, past Black Friday and Christmas, holiday shopping is over. Now at the beginning of the year, real job growth, right? Why are there a lot of job openings post-COVID? Well, people were laid off, right? People weren't at work. People were working at home. Companies are laying people off and not closing the job down. Now companies are realizing, oh, I didn't need 2 procurement folks for this job. I didn't need 3 accountants for this job. Let's just eliminate the unnecessary job and consolidate the work. That's what you're seeing. The expectation is the forecast is we're going to go up a little bit. So a few more jobs are going to be forecast to be open. That's going to be actually one of the bigger metrics that'll move the market. And that's coming out this morning too. So pre-Fed, we might get some catalysts. Any dips that come up, I'm going to long right back to where that dip comes from. So I'm going to basically take some little V-shaped plays, depending on what we get. If I can find some really small scalps, maybe 5 micros a pop. And then so some good catalysts coming through. As you come through and you beat on jobs expectations. When you open up more jobs, it allows workers to shop between 2 companies. So if there's one available worker and one available job, that's pretty much that worker and that job, they need each other. If there's 2 jobs and 1 worker, that worker can compete with the 2 and shop for the better rate for themselves. So in that process, when there's more jobs and workers, wages go up because workers can ask for more as the jobs are competing for the 1 worker. That's what happened post-COVID. That caused inflation. Imagine the one truck driver with 10 different lumber yards needing a truck driver. He literally can ask for any salary he wants, and the one that's the most desperate will pay. And the other way around, fewer jobs and more people getting laid off, wages will plummet. Imagine 20 people who are that 3rd accountant fired, and 1 accounting job pops up. Well, that job now has 20 resumes on its desk. They're going to go to the lowest bidder. So in this case, you want to see jolts coming down and people being unemployed. I know it sounds a little morbid, but for trading, for a bull market, that's what you want to see. Because when wages are coming down, the Fed can be hands off. They don't need to push so hard on rate hikes to control inflation. The rate hikes don't even control inflation. The rate hikes literally are a scam. Can everybody click that like button real quick? I'm going to drop a knowledge bomb. It's going to really change your mind if you never heard this before. The rate hikes are a scam in this environment if you believe that they're costing or causing any inflection points in inflation. They're not. All rate hikes are doing is scaring Wall Street to sell off stocks, to scare companies, to fire workers and become more efficient. Their entire ploy is to force 5 to 10% layoffs by scaring Wall Street. Raising rates in this environment is not going to destimulate any lending. That's not why there's inflation from hypereconomic activity from overstimulated lending, which can control with rate hikes. In this case, rate hikes aren't doing anything to the economy. They're just tricking Wall Street. Does that make sense? It's a pretty cool relationship. So this is what we want to look for. Earnings coming up tomorrow. Big day tomorrow. And that's literally all Powell wanted to do, was force companies, like slap him in the face a little bit. Hey, stop paying the guy that goes to the Zoom call once a week and sleeps the other 4 days a week 75% more on his salary. Fire this guy. Or, okay, well, we're going to raise rates and Wall Street's going to sell off. It's almost like holding the labor market hostage. We're going to raise rates and kill the stock market until you start firing people. And that effect of firing people and forcing companies to optimize to save their stock prices and improve their bottom line is all the FOMC is trying to accomplish. They're not trying to drive us into stagflation or a Great Depression. They're trying to sell and get risk off the table at the top and let their assets roll off the balance sheet. So they're no longer like boosting the treasury, which is what they've been doing since the last recession. They need to get out of that trade and let the market move on its own. Yes. But they also don't need to be raising rates at the same time, but they had to because of COVID. So the two things are happening concurrently because of COVID. If we didn't have COVID, we'd just be in a period of QT without rate hikes. So rate hikes are needed because all of you folks want to go out there and buy cartoon monkeys with your stupid COVID money. People out there buying stupid things. The Fed's like, all right, we got to slow this down a little bit. People are way too engorged with money that they're buying, cartoons for $100,000 a pop. This is getting a little ridiculous, and this is where bubbles form. So let's go ahead and shake Wall Street up a bit. And I'm kind of glad that they did. It sucks if you lost your job, but imagine where we'd be if the NFT bubble led into something even more stupid and then we crashed, right? Imagine all of us beating each other up in a Kroger for the last loaf of bread. Ugh. How do you explain the strength in the dollar from the hikes? The strength of the dollar, are you talking about here or abroad, Travis? The rate hikes right now, the effect of the spending power, like of the dollar, if you're talking, I guess, locally or relative to other currencies. We can have that discussion after the market opens. We got 1 minute till market opens. But let's get ready to go. Get your rocket scooter front and center. Get your liquidity maps front and center. Ready to go. We have some really good news coming up again. We have Apple and Google, Amazon, Eli Lilly tomorrow. We got Jolts in a little bit. Today we've got FOMC, so it's gonna be a big deal. So I'm gonna be fully flat going to FOMC. That's one of the big tricks. And I don't trade until 30 minutes in. We have the ISM manufacturing numbers coming in for January, and that's in 30 minutes as well. This is a big news day today. A lot of stuff coming out. Thursday, we're going to have the continuing and initial jobless claims. That's the other metric for inflation. I'm going to teach you guys everything you need to know. You turn on CNBC after this, you're going to be behind the news. Why don't you predict the inflation instead of let them tell you what it is? We'll show you how that works. Hang tight and click that like button while you're here. Ready to go. Markets open, nice and rational. I'll go ahead and pre-mark some of my DD bands here. Right out the door. Let me get the classic app out. If you guys don't have access to the Rocket Scooter stuff, we have a free trial. I want you guys to all go and check it out. I'm going to give you a link. Our software is free for you to use for 1 week. No credit card or nothing. There's no reason for you not to grab it. You get all this data to come through today. You can come hang out with us. Looks like we're a bull long so far out the door. MHP is on the way coming in. Resilience is positive. This is good. Get these DD numbers getting ready to be calculated. All right, looking for dips to buy today. I like it. Right out the door. We're going to have a long up situation, so hedge pressure longs are going to be great. We have middle of the DD band, which is good. Let me see what we get on the liquidity map on. BLU, perfect. Okay, and resilience is positive, and we're at the bottom of the redistribution zone. Oh, boy. Okay, let's go ahead and... I'm going to assume that's positive. Okay. Let me give it 1 minute. I'm going to buy the first dip and add 3 contracts that first dip. Okay, resilience is negative. Wait. Let's go ahead and let me zoom in on this resilience here. I need res to be positive. That was a pretty nasty dive. Let me see what Nasdaq's looking like. Okay, negative resilience. Change that. Okay, I'm going to let market fall to hedge pressure today. This is a pretty decent dip. Good. No positions today. If the CD number comes in positive, then we are support down over here at 4029. Let me look for some plays here. I'm going to search for all long ups today to match the S&P. Long up, long up, long up. Let's find some stocks. Let me let my team know this. Hold on really quick. Okay, so unless rest stabilizes, I'm going to let the market pull back today. This is good. This is good. Get a lower low. Okay, so ooh, that is actually a pretty quick reversal here. All right, let me see what I got. Ooh, that opening volatility is pretty crazy. Can we just check QQQ really quick? That's kind of scaring me a little bit, but Nasdaq is actually looking really strong today. And again, being at that bottom of that redistribution zone, that's actually a pretty decent sign. But again, that just scalp goes in between these two white lines. So with the resilience being very negative on the S&P pulls the Nasdaq. So markets are going to come down today a little bit, which is great. I'd love to get some long off of there just to scalp. And that's a pretty decently long ride, but it's still within those TD bands, which is good. Okay, neat. Let's look at UVXY. Let's check the VIX in the morning. Close your puts from yesterday. How'd it go, dude? Okay, look, so nice and clean. We are liquidity pocket for UVXY, which means the market does have a little bit of upside potential as we go to this. If number of tickers is less, they expand. Oh, I see. Oh, that's what he said. So whenever there's a fewer number of tickers, they expand to fill that space. Interesting. Okay, so some plays today. We're going to look for some dips to buy. Something that's got a little bit of run on these LUs here. So I'm going to let the market pull back. That was a pretty good prediction here. 4 for 4 on the trading challenge. So I'm doing pretty okay here. Let's go ahead and run. Make sure I have these correctly. I'm going to get these DD bands exactly the same while we're waiting for the market to pull back. No trading until FOMC unless I get a nice little bump. I'd love to see those JOLTS numbers come through and shock the market a little lower. Now, the thing is that we probably have like 3 points of drop to that bull zone, which is a little good. But I mean, even if we fall 30 points, we're going to be pretty much squeezing out of these DD bands. So I need to find exactly what that low number is really quick. Okay, so we're talking right at the open, 403.8, which is right here. 403.09. And we got about 409 and some change right up here. Is that true, 409? So market's pulling back. That's good. Resilience is negative, so we have resistance at the open. But because it's a long up and a really strong DD, I'm not shorting it. So this is a very, very, very good day. This gets some big gains today. Ooh, I love it. Okay, so ready? Ready? Let's go. You want to learn some tricks? Smash that like button while you're here. That's the free part. I want everybody to do it. If I see 100 likes in the next 1 minute, I'm going to show you the coolest thing you've ever seen. I'm going to give you a hint. It's probably a picture of 2 kittens. Yeah, it's really strong and positive, so this is great. So what I want to see today is, because the DD is positive, right? Or DD is greater than half. We have support there. Bull long up means we have support-ish here, but remember, there is a liquidity pocket, so be careful, right? Market's going to be random from here. So I'm going to have very tight stops on the other side of hedge pressure. Res is less than 0, and we're in mode 2 because it's below redistribution zone, right? So this is an easy day today. So we have resistance, right? Pretty simple. So the market's going to love consolidating in that area. So what I'm going to do is I'm going to wait for some catalysts to burp us on a dip. This res is less than zero. So we're not going to rally today, and we've got really strong support here. It's greater than half. So I'm going to let the market fall, hopefully on a catalyst, move its way lower, right, into FOMC. It's probably going to do something weird. And if we get like a nice little dip, I'm going to scalp it either to a red line on those little V-shaped dips right here. Or breaking hedge pressure, we're going to fall. I'd hate for the market to go higher before FOMC than turn off. This DD 0.8 means we want to touch this lower line. So imagine getting a dip from here and longing to there. Already I got my Fed trade in my back pocket ready to go. I love it. So FOMC, man, I'd like to get long right at 409 and just trade from one side of DD to the other. That'd be super cute, right? Things looking pretty good. Let me... Yeah, so I'm going to trade FOMC for sure. Just right out the door, like this is not a long signal, right? So with these resiliences being negative, this is market's likely to resist down here and pull back. So I'm going to post this in Discord, just so I know this. Down before up, in my opinion. All right, so finding some plays. Ones that are on this hedge pressure side that are pulling back. Let's actually be a little clever, right? If I think the index, both of them look like they're going to pull back, let's find some bear setups that are right against hedge or monthly hedge. Let's find some short things for you guys looking to short. That's how you run the scanner. Moderna's still looking pretty booty. It's been looking gross for the last couple days. Kind of talking about that. Let's clear that off. This BRSU, so anything that's resisting hedge pressures, there's some short ops from one side to the other. I'd like to find those. Snap. So with resilience being very, 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 very bad, this is a short setup right here. I don't know if I want to take it or not, but this is a false green, so no longs for me today until this guy gets to be positive. Market's not rational or not irrational or random, so we're expecting resilience to lead the market. So this little green candle is probably a false up. So we're going to look at that real quick. Just pre-positioning for jolts coming out. So nothing yet, right? So I'm debating if I just want to kind of go off the cuff and come in and take a short. So what I'd like to see is when these when the jolts come out, right? So keep two things in mind. As non-farms go up, right? More people get jobs. The chance of the Fed raising rates further to control wages goes up. So when you see fewer jobs on the non-farms, it's actually bullish. It's the opposite of what you think mathematically. Maybe I should take a short scalp, but we'll see. The only reason for that would be on that resilience level. DD is positive and resilience is negative. It's a little competition there. So non-farm employment, right? Fewer and fewer and fewer people. This is good, right? As this number comes down, the ADP numbers are very, very, very bad. It means the FOMC is likely to stop raising rates. I mean, that's the whole point. And that's what my prediction was. You guys remember last year I said by the summer, the FOMC will be raising rates 0. They won't be cutting, but they'll be raising rates by 0. Snap looks pretty good on that short side play. Let's get SPY front center again. I think I do want to take a short. Res is negative. We're on half gap. Let's just be crafty here, right? Now, again, with the catalyst coming up, I'm a little nervous about doing so. Well, if we tap through and hit that half gap resistance, I'm gonna pop a little short on this. How's it possible that DD is positive? DD is positioning in options. Resilience is where the stocks actually are and they open up in gap. Now, this is making me a little nervous, but let's kill the win streak. I'm just gonna do like 2 or 3. I'm going to put it in a little bit higher, right at half gap. So as long as resilience stays up, so what happens is the stocks are actually selling pretty hard and gapping down with a lot of power to gap down. The S&P itself, though, the stocks do have bullish positioning right now because a lot of people do want to be long this thing and improving, economic conditions. So the positioning is long as of yesterday and the day before, but the actual stocks this morning are not, right? So while it is a nice, tight, flat day, I am going to take the bet that we are going to pull back a little bit. Now, remember, resilience being negative is my only guide here to short against the BLU in a bull market. So that's a really scary thing to do. If resilience goes positive, then clearly we're here. With DD being greater than half, I expect the market to go here. So I'm gonna have a very complex day today. I usually say no flip-flopping. I'm actually flip-flop a couple times. I do want to scalp to find some lower lows and the market stabilizing here. Ideally, what'd be nice is I'm trying to pre-position for jolts. If we get a nice little jolt that bumps up and resilience stays negative, I'm going to short it back down to here. And that's what I'm trying to do, just scalping this redistribution zone. Just to show you some tricks while we're waiting for FOMC. Now, the trick for FOMC is that before the actual event, personally will be flat. So make sure you got the timing on this today. 17 minutes, we have jolts coming through. EIA numbers come out for oil. If you're an oil trader, that comes out 9:30 my time, which is an hour behind New York. And the FOMC is coming out today. Am I sure that I got this set at Central Time? There we go. Remember my selection, dang it. That res is still really negative. I'm a maverick. Let's go slightly bigger. Again, on those green candles, I'm just building a short to reject half gap right here. So that looks pretty good. I'm going to save the other half to reject the top part. So I'm not going to go full in. I'm just going to go half in right there. My max position size is 10 based on my equation that I use. And then we got what? Today, FOMC is going to be at 1 o'clock. So leading into my first couple scalps, I'm going to be basically in no trade going into FOMC. I'd like to see this balance point again. How far down am I shorting? Resilience when markets are rational. The rule at Rocket Scooter is resilience is never wrong. You guys got to like that. We always say resilience means that this is the rate of implied hedging of the stocks relative to their gap ups or downs. This has to do with the imbalance of shares between the close and opening of today. There's two modes of resilience. I'll teach you guys. We have a video on this, but I encourage you to all try out the Rocket Scooter stuff. If you guys have never seen what we do before, go to the Discord. It's the best dang trading Discord on this side of Houston. Maybe on this side of my street. There might be a couple of cool Discords down the street, but try this one really quick. Go there. Go here and check out the free trial of the software. Literally 7 days, you can have these indicators. There are no indications in here that anyone else invented. The techniques we have here, we've invented ourselves. If you guys don't, y'all want to see something new and learn something new, fully transparent live streaming trading challenge on YouTube. The only person that trades live, that trades with an account number on the screen, that trades with the P&L on the screen, that trades with the account balance on the screen, that shows the account history and a broker statement in the Discord. Literally the only person on YouTube that does that. You can be more transparent. Let you give my accountant a call and sat with him as he did my taxes. So stick around. You want to watch a real trader. Everyone else that you'll see on YouTube or anything else is paper trading and sim trading. That's why I don't show you historic broker statements. So just tell you guys this. Don't listen to the song and dance of your trading guru. They always have a really elaborate excuse. The more elaborate, the bigger the lie. The only reason you don't see connected days with dates at the bottom of P&L is because they don't want you to see that they suck at trading. And they're just gambling with paper to get you to buy their crappy products. So don't do that. Stick around. Watch me lose real money for your entertainment. That's really fun. I should only be scalping to the bottom of the redistribution zone. Yeah, I'm not paying attention right now because I was trying to look at the news and talk to Amjad. But yeah, this is it. Scalping from here to here was the goal. But I am actually betting further that we do trade lower. I was trying to get my pencil here so I can start writing. So if you guys like what you see, fully transparent on the screen, I'm going to trade this to 100K or 0, whichever happens first. Res less than 0. This is mode 1. Right? Which is inside of what we call the redistribution zone. I issued a challenge to the public, right? I was like, I'm gonna do a trading challenge, and anybody's welcome to join me. As a matter of fact, if you show me like a couple years of broker statements, I'll give you $10,000 and a trading account to trade, and we'll go head to head, and we'll donate it all to charity. It was basically what I said, and when I people were like, oh, I'll take your free money, and then when I said, well, I need a broker statement because I'm not going to hand free money to who I know is a sim trader, a paper trader. You have to prove to me you've been really trading all year, so I'll give you some charity money. I want to go head to head with an actual trader, not with a fake trader. And when I said broker statements, it scared everybody off. So this is a challenge of me against myself, and everyone has an elaborate excuse why they didn't want to play that challenge, but it really comes down to the broker statement. Nobody wanted to pony up. And that says a whole lot about the trading community. So then after I made a tweet, a lot of my friends that are real traders are like, oh, hell yeah, let's do a trading contest. So what's going to be badass is that we're going to have an actual group trading contest with a bunch of traders. I have a lot of my really good friends stepped up and they're like, let's do it. So the CEO of Trade Ideas, who's a pretty cool dude, Trade Ideas is a tech company that makes a scanner. I'm gonna give shout outs to all the people that said they'll do it. So Trade Ideas makes a scanner, right? They're very popular. And the CEO, he reached out, he's like, bro, I'm in. So I'm like, okay, cool. So it's gonna be me, the CEO of Trade Ideas. Simply Sim, she's like, I'm in. And everybody knows Simply Sim's a fucking beast. So I was actually, when she said she was gonna enter, I was like, oh crap, okay, now I'm scared. But the idea is that people were like, oh shit, let's do it. So now we're gonna actually do a group trading challenge, and we're gonna have an open entry. People can all enter. And we're gonna have like a thing where everybody just basically, there's a rule to say, hey, you just got to prove that you're really trading. And for them, they easily did it. Like they're just like, yeah, you know, I'm in, here it is. And I'm like, oh, sweet. So we're going to have a thing to anybody out there. I know Alpha Labs here, Justin even came up and said, yo, I'd like to do it. Count me in too. And Justin sent me his performance. People were literally coming out of the woodwork and they're like, hey, I'm a trader and nobody knows me. But, so you see Alpha Labs trading. I'll give Justin a holler. He rose to the occasion and was like, I'll do it. So we're going to have like a bracket, right? We're going to pull everybody together. We're all going to set some rules, and we're going to do a fun competition between each other, and the gains will go to charity of the winner's choice. So what a cool event, right? That we're going to do that. Why am I shorting against liquidity map? I'm only playing on the catalyst, which is going to be resilience is less than 0. Resilience trumps all. The DD band rule is the stronger of the rule. So after FOMC, I do want to be long going to the top. I'm only shorting the resilience right now because it's less than 0. It's actually really, really less than 0. Nasdaq's looking a little booty. I'm only scalping redistribution zone right now. I got the trade. I was just talking too much and I forgot to close out. So I'm just playing it one more time. DD conversions for SPY. Yeah, they're on here. Here's the thing. You guys have to learn a little bit about this math here. The bot that converts SPY to DD, you have to understand that SPY DD will move around. The ES futures is where DDs are calculated, right? So DD is a band, and this is something if you're just new to the group, you'll see that there's a fixed band that we use in futures to know when markets are rational or irrational. Actually, today, I believe the market is going up. So shorting against it is not really the wisest thing. But I am shorting it for it to go down and eventually at the middle of the day go up. It's a kind of a more complex strategy for your entertainment instead of me sitting here doing nothing. I'm really kind of excited to short against resilience right now. If it goes positive, I'm going to squeeze out and just call it a day until I get something better later. But I do think in general that this DD band, the rule is we're going to the upper band for the lower band. I want to scalp through here and then sit tight. And then if FOMC gives me a dip, I'm going to long from one side to the other. I do want to be long in general, but I don't want to long against resilience right now in a rational market. This is telling me the stocks are selling off. This is a fake up in my opinion. So, and these DD bands are fixed, right, as my upper and lower targets in futures because they're calculated from futures. So the fact that they're fixed and we convert them to a number in the S&P, you guys have to understand that the S&P and the ES fluctuate, right? One will move up slightly faster than the other. And because of that, if you have a fixed ES band, right? And then you have ES trading and SPY is like, you know, trading along with it, but moving around. Then your converting bands are going to move in real time. So when we actually do these in Rocket Scooter Automated, you have to understand that your SPY, everybody in chat, if you can type yes, if you understand, these move in real time. So when I did the bot to try to anchor them, like 3 or 4 of you kept coming out and messaging me saying, hey, by the way, you know, the numbers are wrong when I did it, and the numbers are wrong when I did it. Well, there's no right or wrong. It's that they move in real time. So these green ones are going to move in real time because you're converting against a fraction that's changing in real time. So the point of that is that you're not going to have static converted bands, right? So as SPY is trading and trading and trading, this line will be moving and moving and moving, and the minute, you know, an unstoppable force meets a movable object, the minute they touch each other, wherever it is, you call that a day. So again, I'm trying to scalp from one side of the zone to the other, which is good, and I do want to see that. So I'm going to go max position size here on the first spike I get, and then short it back down to here. And we're going to wait 8 minutes to do that so we can get a little bit of a position on jolts. Risky. And I don't normally short against the bull market. I don't. And I don't normally flip-flop. But today I'd like to scalp from here down to the bottom. What was my first entry? Was at 79. And we're at 86. Ooh. Okay. We had stocks filling their gaps here. Let's go ahead and do on the scanner. Let me clear everything out. Remember, going into Fed, I don't expect the market to be doing much rallying. Let's look for half gap breakups. We're going to find any stock that has moved up through its half gap and find ones that are right on the edge. We're going to keep it right here. So these are stocks that are breaking through. I'm going to look for any big hitters. Pressing into zero, supporting that. Okay, so NASDAQ is pushing ahead. Let's see if that resistance on QQQ. The NASDAQ resilience is still just really negative. And the interesting thing is that this is going into major tech earnings we have today. So, all right, ready, set, go. A little dangerous going into a pre-catalyst trade. So we have jolts coming up again in 6 minutes. You may not think it's important, but jolts are one of the two most important. I mean, not jolts. Sorry. Jolts and first-time unemployment filings are the two most important metrics when it comes to looking at inflation today. Yeah, some parallel universe, right? Matt's going to do some shorts just to keep people entertained pre-Fed. That's it. So when these jolts come out, what you want to see is the market's going to respond to it. I want to get a quick dip and close out this short. I'm just scalping redistribution zone on negative resilience, right? Strong DD means ultimately the market's going to move up higher. Negative resilience means I'm expecting a little bit of choppiness going into that. So these jolts numbers, right? Fewer job openings basically will go along with lower inflation CPI numbers. So as jolts go down, CPI numbers should come down. They go hand in hand. Fewer jobs means more competitiveness when it comes to workers looking for jobs. So it means that the workers themselves will want lower wages. So there's that S&P resilience, still negative, still negative. Let me resize this just a little bit. Hey, can somebody, for me, check something really quick? When you scoot your borders left and right, is it kind of glitching that way, or is it fluid when you do it? I just might need to reset my platform, or refresh my platform. I know, Matt never shorts. I mean, short scalping. Yeah, I'm not really quick. I trust resilience more than I trust liquidity map. It supersedes it. So how this works, Okay. And if you go to our strat summary table, it'll show you the priority of things, right? So at the top, index catalyst is FOMC. That's top of the list. Outside the DD band, right? These are all irrational signals. So we don't have any of these really flagging today, except for the catalyst coming up soon. We have an index catalyst potentially with the jolts, which is why I'm shorting, but I don't think it's going to be that big because we have FOMC today and 3 major earnings tomorrow, right? Actually, today's major earnings too, I think, right? We have something big today. So I have a video called like what I do pre-market. In the video, yeah, today is Meta. And the video talks about like what all these tabs are I have, like financial juice and all these things. This is how I always kind of keep a tab of what's going on in the market. And these are all really good metrics to look at, especially at the economic calendar, to understand like knowing your news when you're day trading is always gonna be very important. That manufacturing PMI just came out, so we're gonna take a look at this. I forgot to mention that. So we came in below or above 50. We came in below 50 and it was a little bit better than last week. So, you know, this is just activity level of purchasing managers. So like the ability for you to access materials in the manufacturing sector, right? Shortages are what you'll see building into this. So, you know, the forecast is just down and down and down and down. This is, you're going to expect to see this in a recession, just a pure decline of that number. Okay, but anyways, back to our priorities. The priorities are really clear. So in these pivot sides, right, liquidity map is like the base priority. Resilience will offset that because it's a more close to now number, which is like where stocks are gapped to or trading to now versus yesterday's close. So hedge pressures and dynamic hedge pressures, hedge pressures and zones are based on options that we get the data from overnight off of yesterday's close. So between overnight and now, when stocks gap, that represents sentiment in Europe and Asia in the overnight. So this is a little much of a sooner, closer to now catalyst to move markets than yesterday's position. So if you have a difference, like liquidity map is bull long up, but resilience is negative, then today's gapping power of stocks are more important than yesterday's position. So people are like pre-positioning good for Fed, but you can see enough market cap is selling off, likely because of, you know, Meta, Google, and Apple earnings. You have those big hitters likely not looking too sweet, right? The last thing is the DD band. This is the bigger catalyst. Here we go. We got those jolts coming out. Looks like we're getting a little pre-market movement here. These DD bands, this is the next thing, right? The ratio being greater than half means we try to go up before down. So, oh, there goes that trade. Here we go. Here we go. Look at that. I told you it's a pretty big catalyst. So let's pay attention to it. There's that dip I wanted to see. And DD band is like the bigger of the two catalysts. So obviously that resistance is really big. Let's see what those numbers came out. People must have got jobs. Let's look. I told you it was going to be a big deal. See, people don't believe me. Jolts are more important than anything right now. Let's see. And you have the ISM coming out as well. Let's see what we got. I'm sorry, ISM. What am I saying? Jolts. I really need to wake up. Both of them came out, right? Okay. So jolts are the most important of these. People say ISM. I was like, where did the number go? People keep saying ISM is the most important thing, but I'm going to tell you, when it comes to inflation and Fed, you want to look at jobs. The labor market is it. Let's go. I'm a little tongue-tied this morning. Oh yeah, people getting their jobs back. Very bearish. Very, 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 job openings going up. Let's start over. More jobs open is relative to two things. Either jobs are being created, which you know is not the case, or people getting laid off. So this is a predictor for the non-farms on Friday. If the jobs are going way, way, way up, or a lot of job openings, it represents current jobs of people just getting cut, but the job is still available. So imagine that the company has like a position, they just laid the person off and they're not filling it, but the position's still open. That's reflecting that. So the FOMC is likely to be less, or likely to maintain a very strong hawkish stance as long as more and more job openings are there. Yeah, let me start over. I'm so backwards today. Fewer jobs, right? Fewer job openings mean that you have more people competing for one job, less wages. More job openings means more flexibility. People can shop a little more. So that's actually perceived as better, not better for jobs, right? Better for lower wages. So better for inflation. I said it the wrong way. Depending on labor. So it's a ratio of the two. Let me draw it really quick. What's resilience looking at today? I can't do double negatives in my head. All right, everybody, smash that like button real quick. I'm about to do something real quick. So, number of jobs, number of workers. Easy if I write it down. I realize when I get to be 41 years old, my brain just doesn't work as good anymore. Nicole always makes fun of me for getting old. I get forgetful. I promise when I was younger, I was smart. Okay. More workers and jobs. They're competing. Wages down. How's my short doing? Oh, hell yeah. Let's go, baby. What? Resilience never wrong. Let's go. Another 4% in the account. Let's go, let's go, let's go. Let's just tap that open and call it a day. Woo, daddy. Let's close out. All right. Boom, baby, boom. We're up 12% in small count challenge. Another win. Haven't lost a trade yet after 60 something trades. Let's fucking go. Smash the like button, ladies and gentlemen. Ooh, happy dance. Not turn on the camera. You guys can watch me happy dance, but Papa hadn't changed out of his PJs yet. Listen, man, resilience is never wrong. I'm going to tell you that when rational markets. I didn't come up with that slogan. You guys did. Resilience is never wrong. Y'all came up with that when rational markets. Let's go. I just nuked the whole thing at the bottom. Scalp in the range. I'm going to call it a day and wait till Fed. No more trades until then. How did you know it would happen? This is what I'm telling you. When you're day trading, you have to understand what actually moves markets. Didn't I say jolts are going to move the markets around? I know people are going to be talking about PMI, but this is what the real... Look at that huge beat. That's not good. Okay, so let me explain what happens, right? You have a couple of things. Let me teach you guys how this works, okay? If you haven't heard this before, you're going to like this. Imagine you have 3 jobs and 3 workers, okay? Now, a company could do one of 2 things. They can eliminate the worker and the job, or we're going to call this case 1, or case 2 is the company can eliminate the worker by keeping the job open, firing the worker. So if a company has a job open and firing the worker, then it will count towards the jolts if they're actively seeking to fill that role with a more competent worker. Let's call him worker plus and worker minus. Worker minus sits on their ass, complains a lot, doesn't do much, and they got fired because, well, we're cutting down 5% of our workforce. This guy had bad performance. Let's let him go. But let's bring in somebody more efficient, right? Now, somebody more efficient is going to want a larger wage, right? Because they're better. But the company believes at, you know, let's not do white. Let's pick a different color. Actually, let's just move this down. So if you're going to leave the job open in case 2 and replace it with a better worker, he's going to want more wages. So the company is going to pay more, which means their bottom line is going to go down a little bit in the short term. But they're going to eventually make up for that because his efficiency is better than worker minus, right? Worker minus just sucks. Worker plus will cost more on the front end and make more on the back end. So the stock price will kind of have this effect. When you replace a bad worker with a good one, the company is going to lose, you know, pay him $20,000 more a year for salary or whatever. So that's off the bottom line. But he might produce $100,000 more a year in results, right? So One thing is to swap worker for another. Another thing is to eliminate the job and the worker. So you have a worker down here and nowhere for him to go. So this bottom line is going to be what we'll call the labor pool, right? This is a one-for-one swap. So essentially, companies are going to expend more money to get more production. That's the slower, what we call productivity growth. This is the GDP line. This is the growth of your economy. People making stuff and a better person making more stuff is slower growth. This is not going to really have a bigger effect on the market other than the company is going to have kind of worse performance in the short term. As this person 3 to 6 months gets really good at their job, the investment into them is for the long haul, and ultimately their growth will be likely exponential for the company as they become uber efficient. Now the other idea is that companies let go of the job, let go of the worker, and we're talking about what's the catalyst today. This is today's catalyst, and this is exactly what I'm shorting, right? These are advanced trading understandings, but if you learn this, you will be very happy you did. In the meantime, I want you all to do me 2 things. Grab the Rocket Scooter platform while you can. You can try out our software for free. My resilience short. Resilience is available in the tool. We invented what resilience is. Resilience told me that was a fake up and I shorted, which was great. This is why I did it. So everybody click both of those links really quick. Keeping a runner for HP touch. Yeah, I think that's probably a smart way to go. Remember, DD is still positive, so the greater good of things would be that I might want to grab along down in here to go up, right? So let's just be very careful. I don't know what this white line is. Oh, that's from my example yesterday. Let's do some monthly maps to do expected volatility. Anytime you're leading into the Fed, another cool trick. Just make sure you understand what the volatility is on the S&P. Remember, we did that yesterday. So back to the jolts, right? You have 2 things that are matter inflation. Inflation right now is the talk of the town, right? Inflation. FOMC is doing something to control inflation. So you have to say what's the cause of inflation. Normally it's like in normal bull markets, inflation's coming from like hyper-economic activity. Everybody gets a credit card. Everybody gets a house. Everybody gets a whatever. Everybody has money. Everybody has jobs. They're buying stuff. They're over-diversifying into silly things. And there's just too much stimulation. Bubbles form and bubbles pop. So Fed usually comes in, raises rates, right? Destimulates some lending, destimulates the credit market, and that slows down. And that's normal inflation, but we have a different kind of inflation. It's called cost push inflation. This is a whole different style. So people are not understanding sometimes the difference between the two. This is where raw materials, labor, and transportation, storage, all the things in the middle, cost more money. So when you have like you producing something, you have like a cost, right? This is the production cost. Plus like a markup, right? Company has a markup equal to sale, right? As the cost of production goes up, the cost of the good goes up. And if people are getting paid the same amount of money, the cost of goods go up because that goes up. That's called cost push inflation. Lack of eggs, lack of truck drivers, lack of whatever causes the inflation. It's not because the market's hyper-stimulated. It's because the market was shut down during a pandemic. You shut everything down for a little bit. Shortages cause inflation. So if FOMC raising rates is a fugazi. That's stupid. That's not what causes the inflation to change. The reason FOMC is raising rates is literally to scare the stock market. Like in normal inflation, FOMC, like 2 things, right? And I'll teach you guys how FOMC does it. And then stimulation inflation, just regular inflation due to a bubble. Rate hikes slows down credit. So we have productivity growth. You have your credit markets cycle like 5 to 7 years like that, right? So the FOMC can start to like destimulate some lending. And let's assume there's no QE or QT. Let's remove the treasury from the equation. And so the FOMC is just destimulating and stimulating the credit bubble so that the bubbles don't get too big and pop and cause depressions. Okay. But in this environment, the FOMC raising rates is literally to scare the stock market so it doesn't form a bubble. Imagine if the FOMC didn't start doing rate hikes. The selling or the balance sheet issues coming from QT are not necessarily what's causing the recession. It's causing some selling, but the selling hit the COVID short that was covering, and that squashed itself a long time ago. QT is not the reason the market's selling off. The reason the market's selling off is simply because productivity is low, and the Fed is threatening companies, I'm going to keep raising rates and kill your stock price unless you lay people off. And so the Fed is forcing companies to become efficient. This is the bottom line of what's going on. This is the real news. If you guys learn this, you'll love it. Jay Powell is telling you in all of his speeches that's what he's doing. Labor market, labor market, labor market. Every speech we'll watch today, I'll show you how to watch the news parts as it coming through. You don't have to listen to the press conference. You just get the data coming through, and I'll show you. You can get it from Financial Juice. And so as he's talking, it's all about eyes on the labor market. It's all about the relationship I'm showing. So if you have more jobs, if you have equal jobs and workers, it's a 1-for-1. If you have open jobs and no longer are you filling them because the company's trying to save money, 3 people competing for 2 jobs, wages go down. This job is like 100K and this guy's like 100K. Hey, I'll take it for 90. I need a job. Okay. If you have more job openings and available workers, wages go up. This person goes 100K. Okay. Hey man, I really need you though. I'll give you 105. Oh shit. All right, cool. Right. Supply and demand is basic economics of supply and demand of labor. This is what's causing inflation, right? So jolts are this number. And I like to use the first time unemployment filings to look for how many people get kicked out of their job. If the company goes, get out of here, you're fired, then that person typically goes and files unemployment that week. You got to pay your bills, right? Especially in an environment when you bought a house, you know, at 40, 50% higher than you should have. You're an idiot that's even more desperate for a job. You're going to ask for even lower wages in the environment. If jolts are going up, more job openings, and first time unemployment is going up, that's a situation where the jobs are available in a 30-day window and people are getting fired and they're looking to replace them with better workers. That's a short-term bearish signal, but a longer-term bullish signal. So again, when job openings are going up, there's more jobs, and first time unemployment goes up, it's people filing for unemployment while the job's still open in the first 30 days. Just to repeat, it means workers are getting fired, but that company's looking to replace them with someone better. That is the equation for, sorry, surf Reddit at home for a job, you're fired. We're going to bring somebody back to the office to do work. Do we understand that relationship? Jolts go up and unemployment goes up. It means people are getting fired and the company's looking to replace them with someone better. So imagine what's going to happen after the first month. In the short term, people are getting fired and companies are going to replace them with something better. So in the short term, companies are going to have to spend a little more money for the better worker, right? Because you have more job openings than workers and they're all fighting for the better worker. So the better worker is going to want more wages. Short-term bullish, long-term, short-term bearish, long-term bullish. Now in the environment where jolts are going up, which they did, and first time unemployment goes down, it means the company is creating the job, not firing the worker. The company says we're expanding. So let's just draw it on the side. This is an economics lesson for you guys. So jolts up, and this is what caused inflation. The real inflation mechanic. Why are we doing this, ladies and gentlemen? Why is this guy talking about this? Why is this rando on the internet talking about this? We're going to predict the FOMC. Okay. You guys ready for this? How come back last year I said the FOMC was going to start tapering rate hikes? And how come every month I've made a tweet, and I can prove it to you. I've made a tweet. Go back and look. I've been right every time. FOMC is going to lower rates, raise rates less, raise rates less, raise rates less. Today it's going to be 25 basis points. Next month is going to be 0. And next month will be 0. And next month will be 0. And next month will be 0. Rate hikes are gone. As of this month, it'll be the last one. All the data points to that. And will be 0 into the summer. And as long as the stock market doesn't crash and we have okay earnings Q1, Q2, and rate hikes are 0, Wall Street will start recovering as all this economics about to go through proves to be good, and we believe in the market. And during this time, do not hesitate for a moment. Do not believe that the rate hikes are over. When we start rallying like we did in 82 to 84, 1982 to 84, you will see rate hikes like you've never seen in your life before. If Wall Street is rallying on good economic data and the market doesn't crash after Q2, I'm going to guess that we're going to get 1 to 2 basis points, 100 to 200 per meeting in the summer. But Wall Street won't care. The Fed is going to prevent a bubble from popping, because if Wall Street starts to heal and do better, they need to still make sure that they don't create a credit bubble on the onset of QT. That's going to be even worse. If a credit bubble pops 5 years from now, they have to raise rates into this so that the economy can grow healthily and slowly and not create a stock market bubble. So after the summer, we're going to get full 100 to 200 to even 300 point raises in a single meeting. You can mark my words. That has happened before a handful of times, and Wall Street always, always, always rallied the market, even against those rate hikes. I think 25 basis points and pause until Q2 earnings, because all they need to do is make sure that the labor market is stabilized and that companies aren't doing bad. The Fed just wanted to induce 5 to 10% layoffs, because really the Fed's job is to control stupidity, right? So if everybody's buying a house at 100% its value added and getting a loan, well, that person may not be able to keep their job over the next 30 years to pay for it, right? So the FOMC has to make sure that people get lower wages. So they're threatening Wall Street with rate hikes because Wall Street always sells during rate hikes. It's just a it's like a puppet, right? You pull the string, we're raising rates, everyone's going to sell the stock. That's normal. And also in the mix of QT, it's a double guarantee you're going to force the stock. Right? QT is existing for a different reason, but the rate hikes are just basically holding the stock market hostage. Until companies fire these people, right? Everyone's in abundance post-COVID, making all this money, hiring all these people. And we used to kind of laugh, right? I know a lot of people that are like, I've been working at home. Even my dad has been working from home since COVID. And he's a big wig at one of the largest phone company on the planet. My dad's a very prominent high level. I'm not gonna tell this. I'm not gonna dox my dad, but he's a high level guy at a really big company, and he's working at home because the company companies are operating so inefficiently, or maybe just realizing they don't need all the labor they used to because everyone's working from home. It's just their company policy. They're gonna let them work from home, and so with everyone working from home, companies are either realizing A, they don't need all the workers they did, they don't need to pay all the salary they did, or B, they just have so much money they can afford to pay people that are doing very low. My dad's doing a lot of work, but a lot of people I know weren't, right? They're sitting at home doing nothing. And that's what we call stupidity. It's the same thing as buying NFTs. No offense if you did, right? If companies are paying people to do nothing, that's making wages go up and making inflation worse, right? So the Fed is like, we need to force you to lay those people off that aren't doing much. So we're going to raise rates until you start laying people off. I mean, that's a handle. If you always study the FOMC, Jay Powell is relatively like one of the most brilliant folks in economics right now. And also the rest of the folks on the board are also really good. You listen to them talking, they say stuff that makes sense. It's not on the surface. But I'm going to tell you between the lines, here's what they're doing. We're going to raise rates until you start laying off 5 or 10%. But we're not going to raise them too much, too fast during QT, or else you'll lay off 20 to 30%. And then we'll kill the economy. If they kill the economy, they have to bail us out, and they don't want to have that problem again. So, you know, if they bail us out in a period of inflation during QT, they can bankrupt. If they crash the market during QT, they can bankrupt the Treasury. And the Treasury can default on its loans. I can't remember if it's the 13th or 14th Amendment. And I think that is actually considered unconstitutional for the Treasury to bankrupt or default on its loan, right? I don't know all the legality of it, but I believe that is where that, maybe it's the 13th Amendment or 14th Amendment. It was the same amendment, Reconstruction with... during abolition. It's all in that same amendment. So in that same amendment, it also says Treasury can't bankrupt. So the government will essentially hold the Fed hostage and force them to bail us out. So the Treasury can't bankrupt. So essentially the Fed is like, okay, let's not bankrupt the government. Or the Fed is. So the Fed is not going to raise or push too hard to crash the market. They're going to push just enough to bleed off the pressure. And that's exactly what we see. You never did get why anybody see any value in NFT. There's value in diversification. Imagine this, right? You max out your 401k, you max out your IRA, you bought enough of every stock that you like, and now you're just getting cash, right? Now you're just making all this money, it's sitting in cash. What are you going to do with it? Well, inflation always is a thing. So the $100,000 you made, the Fed always targets 2% inflation. So your cash is losing 2% a year. You may not think a lot about that if it's $1,000 in your bank account. You're going to lose $20 a year. But if you have $1 million in your bank account, you really would care about losing $20,000 a year due to inflation. And that's per year on top of per year. 2% this year, 2% next year, 2% next year. Your money's going to shrink if you don't invest it. So as you fully invested in everything that's like, you know, safe, you have to start investing in more and more things. You run out of things to invest in. That's what causes credit cycles and bubbles. You run out of things to buy. And when you're making more money and you've run out of things to buy, then you have to look for things to buy. And that's where stupid things become valuable. Do we all understand that? Otis and Lyris and everyone else? Your cash is going to shrink. So it's stupid to hold. It's dumber to just hold on to your cash. So you're going to invest in riskier and riskier and riskier things. So it's like, okay. And it's like, why do you think people were laughing like, you know, Jimmy Fallon and Snoop Dogg and everybody about these NFTs? But it's not because they're dumb investors. They're smart investors. They've over diversified. Snoop Dogg owns a gin brand. Why do you think people go out and invest their money in businesses? Because right now, everybody's got a cologne and an alcohol brand and whatever, because that rich, you need to diversify. You have to put your money somewhere. If you want your kids to inherit something, you don't want them to inherit a pile of cash. You want them to inherit a business that can outpace inflation with the cash. Got it? So stupidity is caused by over diversification. People just go riskier and riskier and riskier until they invest in things that make no sense. But they expect other people to invest in it too, because they're also hitting a block on the smart things. And when you are the first in something, you expect people to pile into it. Well, that's supply and demand. And then your stupid investment becomes a smart investment against people, not investment against NFTs. The dumb people that believe in NFTs are just dumb people. But people that believe that NFTs are going to be a flux for other investors are smart people, but you got to be first in the trade, which means you have to be rich enough that your economic advisor tells you to diversify into it. Okay, so anyways, diversification causes bubbles. That's what we're saying. And the more money you have, the more bubbles you have. Fed will control inflation to prevent people from having so much credit. They're borrowing so much money. You know, when you get a credit card that you max out, or say you get a loan, right, that matures in 10 years. And you pay interest on the loan, which means you're borrowing money from yourself, your future self, 10 years from now. And you're also betting that you've made that interest in raises to be able to afford that loan. If you don't grow your job into that wage, then you default on your loan, or if you lose your job, you default on your loan. So the risk of like lending comes from that. I'm making no more trades today till FOMC bounces on there. That's what I'm looking for. Me asking. So back to what's going on with the market. So these are the two things I'm going to show you. Okay, ready? Jolts are the number of jobs open that can be filled in a 30-day window. First-time unemployment are people that just got laid off. These two numbers, inflation and cost push inflation right now, is caused by shortages of stuff plus wages. Shortages caused the first wave of inflation. You shut everything down during COVID. Massive shortages cause inflation, which also shortage of goods and materials. Once stockpiles depleted, then the truck driver had nothing to take. He got fired, and he had shortages of jobs. And then abundance of labor. People rushed in as somebody needed the truck driver. Fewer people wanted to risk their lives during COVID. If that was their belief, they decided to stay home. Then the more adventurous people got the job when there was more jobs and workers. So wages went way up. So the shortages went up and then started to deplete, and then wages went way up. So wave 2 of this inflation is caused by wage inflation, okay? And shortages are taking like a secondary run up as people are getting laid off. So you're going to see those shortages kind of deplete, and wages are going to like slowly trickle down. And the Fed is trying to stabilize both of them. It's probably a 2 to 3 year process. And we're going through this particular mode right now where wages have started to stabilize. And you're seeing like, you know, shortages in all the things, like available houses for sale, shortages in lumber, shortages in oil, shortages in all the things. And then that stabilized, and now we're getting spot market shortages. And the joke now is eggs, right? So in general, most things you can go buy these days. And in general, your inefficient labor has all been laid off. So all the pieces are in play, and brilliant Fed has created exactly what they wanted to do, is stabilize the job market. Now let's look at the metrics that go into that. So jolts and first-time unemployment are how you're going to predict the Fed every time. So you have a mechanism of, this is mechanism 1. Box is a job. W is a worker. Okay, worker gets fired. Job is still open. Jolts go up by 1. This guy files for unemployment in the first week. Jolts is a 30-day window. So we're going to call it unemployment. Goes up. This situation is healthy, right, company. Because remember, jolts require this job to actively be accepting resumes for. Healthy company laying off bad worker. In this environment, the healthy company is looking for a better worker. It means they've got free cash flow. Because if you're going to bring in a better worker, you have to pay them more. So the perception of those two going up is Wall Street bullish. Because if companies have free cash flow to pay for a more expensive worker, free cash flow is actually the most important metric during earnings, isn't it, right? $50 pizza in Nassau this weekend? Oh my God. Bro. It's crazy. And somebody says they never saw the value in the NFT. The value in the NFT was to pay for a rich person's club that had a seat that went up in value. And it was like the seat that went up in value was the demand. And the demand was there because there was a bubble. And, you know, you have to diversify into anything that you don't hit inflation. So remember, y'all get this, right? If you're firing somebody, jolts go up. If you're leaving the job open, jolts go up, and that person is filing for unemployment. In this situation, this person is unable to get a job because there's no new job for him to get. And somebody that's unemployed is going to go into the job. So continuing unemployment claims go down. So first person, like somebody that was unemployed, is going to get his job in a month. So within the month, you'll see the continuing jobless claims come down by that guy getting replaced by a better worker. Wall Street sees that as bullish because you're not going to fire somebody to hire somebody else unless you have more money to pay for them. If you have free cash flow, doesn't that mean bullish for earnings, right? That's one of the major metrics. So this is the first thing. This relationship is bullish. Second thing, worker. Job is shut down and that person's unemployed. And in this instance, jolts go down, right? Less job openings because they're not trying to fill. First unemployment goes up because this person files unemployment. And continuing unemployment's the same. This is a company closing down a job and not hiring somebody back. This is a company trying to free up cash flow. It's even seen as short-term bullish, long-term bearish. More bullish. Because it's more cash flow. More bullish short-term. Questionably not so good long-term. Companies are, well, I mean, they're becoming more efficient or they're struggling. It's going to be hit or miss. So I'm saying not sure. Why is your company eliminating their job? They realize they didn't need 3 accountants, so they may realize, shit, let me double up on this employee's work because we can't afford to pay 2 people. So it's really hard to say, but in the short term, that's actually seen as very bullish. Okay. So this is the effect of lay off bad person, right? Lay off inefficient guy. This is cutting, closing jobs. All right, I guess I ran out of room. Number 3 is creating jobs, right? You have worker, and then now a company is creating jobs, right? So you have the available worker now, right? That was on unemployment already, now has a job to choose from. Let's do, actually, this is number 4. Number 3 is the same thing, worker with 1 job, right? And this, in number 3, this person has a job to go for. It's 1-to-1. He needs a job, they need a worker. It's going to be, I got the job, take it or leave it. Yeah, I'll take it, fine. So this has really like no big effect on anything. Jolts go down, right? The job opening, jolts go down. First unemployment, no change because there's nobody being laid off. And continuing unemployment goes down. Company is going to lose money in the bottom line, short-term bearish, long-term bullish, right? This is a healthy economy. Job growth. It's slower though, short-term bearish, longer-term bullish. Because the short-term is bearish. Like the knee-jerk. Medium to long-term bullish, very bullish. This is a healthy economy. And this is like booming economy, right? Booming economy. 1 worker, 3 jobs, right? So jolts went up because they created 3 jobs. First unemployment is sideways because nobody's getting laid off. And continuing unemployment is down. This is what we call bubble economy. Bubble. So when you have more jobs than workers, that's your bubble. That's your wages. Wage bubble. Do you all understand? Oh boy, this is crazy. So these are actually the things that control the Fed. Let's predict the Fed's going to do. I'm going to take a picture of this. I know I scribbled all over the screen.
By the way, if you're here for the first time, right, 100% win rate so far on the challenge, 5 days without taking a single trading loss. We fucking killed it, right? Let's see if any one of these contracts. Wait, I got one at 75, 25 I exited. Yeah. So we're good. Let me keep this. Post this in Discord. Everybody head over to the Discord. Now let's predict the Fed. You ready? You ready to predict the Fed? Let's do it. Invite everybody to head over to our Discord. You're going to learn a whole lot here. Okay, I'm just going to remove all this on the screen. So let's look at the data. You ready to solve the puzzle? Okay. Let's just trace what we see. And I'm going to show you something very cool on how you can use what I'm just now showing you to predict Wall Street, to predict the stock market and predict the Fed. Ready? Let's just put them side by side. I promise if you pay attention here, you'll learn something big. Okay. So this is, we'll say COVID. We'll make them the same size. We'll do this now. Yes. Let's not. Okay. So there's your jolts. Probably should have made it bigger. Now let's look at the other two things, right? And this is what's actually causing inflation. It's a very cool. Are we learning something? Is this simple? Is this making sense? All right. Now let's look at the first time and continuing unemployments, right? And non-farms will also work into this as well, but those come in Thursday. So let's look at the initials, right? Initial jobless claims are people that just filed for unemployment. I'm going to talk about why I shorted today. Why I shorted today. Resilience, but I also needed the catalyst to get me out of that trade, and I'm glad I did, right? So that was the jolts. Again, when you're day trading, there's all kind of advanced tricks. You can see stuff other people don't see. You're doing things right. I try to do that as much as possible. Doesn't mean I'm always right. But let's go back and let's look at the old COVID. Let's put them like side by side. Let's try to make them the same length, right? And I hate that the COVID's going to like really skew that graph. But we'll kind of like draw the relationship, right? Let's just say that like I want it to be like the same size. Okay. I know it's very hard to see, but I'm actually going to have to do a little bit of. Can I change? It'd be cool if I could change this axis. Hold on. It's going to be kind of hard to see. Oh, I can't. Okay. Let me just draw like these inflection points here. Here. Okay. I'm just going to try to freehand this because it's really hard to see on that. I'm going to move this off the screen so I can get those. Okay. So this is the first time unemployment. Let's just move this out of the way here. I'm going to draw what we see with a different color. These are those inflection points. So you'll see that first time unemployment goes way up. Right? Actually, sorry. Like unemployment was way up, went down, up, down, up, down, up, down. Okay. Oops. So in the particular mode right now, first time unemployment is actually going down. That's very important. Now let's look at the continuing. And these numbers come out tomorrow are going to be movers that are just as big That's what the FOMC is going to say today. This is going to predict next month's FOMC initials. And you can actually see what Wall Street's forecasting that to see what they're going to look for. It's going to look fairly similar at the beginning of COVID. And also it's going to have that same look, right? So you can see that right now they're going to be the same. I'm not going to draw a second graph. First unemployment and continuing unemployment is down. Okay, so let's talk about that case. Going back to the thing I posted in chat today. Let's get that back and forth. So we actually didn't talk about this case. Right? We talked about, let's look at the cases where jolts are going up. Okay. Jolts are up with both unemployments going down. The closest thing we have to this is here. Wage bubble. So let's go ahead and talk about the case. And I guess we'll put this in there for the fifth case. There's a couple more. I mean, there's obviously 6 parameters. So you have 3 factorial, which is 6 possibilities. We only talk about 4 of them. So let's talk about number 5. Let's just weigh it out, right? So what happens if you have more job openings? And one person that got fired last month, let's see, month 1 or last week, first time unemployment is down, which means fewer people are getting fired. It's putting in plain English, right? Fewer people fired. So you can say layoffs are practically slowing down. Continuing unemployment down, which means previously fired people going back to work. Fired people like greater than 1 week ago going back to work. Okay, so in an economic sense, this is actually good for the economy, right? More people, more jobs, more money in the 401ks, more spending. Yeah, this is healthy economy. And jobs going up can be perceived one of 2 things. If there are fewer people getting fired, then the jolts going up has nothing to do with layoffs. That has to do with job creation. There are more and more and more jobs available than there were workers that are going back to the job. So what it means is job growth. This entire thing is equal to job growth. Right? That's bad for the economy in the short, bad for wages in the short term. More jobs being created with fewer people to fill them, again, leads to wage inflation. Okay, does that make sense? So jolts going up as fewer people are laid off, it means like the work pool is going back to work with more jobs available. So you can go 1 for 1, right? Let's look at the slopes of those lines. And if you have more jobs and available workers, wages go back up, which is inflationary, which is perceived as bearish. Do we get it? There's your aha moment. So you want to see something even cooler? This is like, I know people like to draw like gross technical analysis junk on their charts, shapes and colors. So here's some shapes and colors that actually work. Let's put 2 numbers side by side. I haven't even done this yet. So let's look at the change week over week, right? And let's see if jobs are outpacing workers. And that's to be FOMC might be more hawkish, right? So let's go like from 2 weeks ago, 1 to 4, okay. Change, and the expectation is another 250K. So expectation, like this is last expectation, this is 250K. Of job openings. We're expecting more job growth, right? So last time was a beat. This time's gonna be a beat. So expectation is job growth. Companies already laid everybody off, had some free cash and more efficient. So job growth. Actually, a lot of jobs. Of 375,000 over the last 2 weeks. Sorry, 2 months. Or I guess month, sorry. Now let's look at how many workers we got there. Like how many people getting fired. So look at the ADP. And again, you're going to see the ADP, the employment change, is like the net sum of these two things, right? Last thing. Okay, so we'll do over the course of the month because that was a month-long metric. Quickly add these up. First time. This is Jones. This is really what, like, if you want to listen to like CNBC tell you inflation numbers, okay. Would you like to predict them before it comes out? Sure, let's do it. First, unemployment. And again, that's a month-long metric, so let's do 4 weeks. This is, let's see, 690, 776, 781, 785. Oh, this is not total. This is change. This is first time unemployment. This is first time unemployment. And actually, let's actually not do it like this. Let's put them all side by side. Let's look at the net difference between the two. The expectation is it's going to go down. Expectation is going to be another 200K. I love doing this. I usually put this in a spreadsheet, but we're doing some live math for you guys. And I'm just waiting for the FOMC, and we're going to make another trade. Hopefully get a bull long up off the bottom hedge pressure. I'd like to take a second scalp there. Expectation is 200. So what was it? 785, so 985. Okay, let's just do it like this. Let's go to continuing. Let's put them side by side. Boom, boom, boom. One more. We'll call it a day. Oh, right. Reset that playlist. Okay, we'll go side by side. Again, same thing. Watch this. Y'all ready to do the math? You only qualify for unemployment insurance, I believe, for 3 months at a time. I believe that's how that works. My education loan is worth more than $9 a month. No one does this. Well, appreciate it, man. Well, this is what happens when your degree requires you to just love looking at data. Like when I have nothing to do, when I worked at the plant, I would always be like chewing over data to try to find cool relationships. That was my job, to save Dow Chemical money. As an engineer, I'd have to sit there, and if I had nothing to do, I'd find something to do. Oh, you know what? I have this problem. Let me see if I can look at data that makes sense. So let's look at like the net change, right? So this is the total number of people qualifying for unemployment at the time. Let's just do like the difference. So we're going to have this is what, 5 weeks and 5 weeks? Okay. So over the course of the month, these people are still gaining benefits, right? So if it's like 800K a week, sorry, 800K a month for the 3 month period, that adds up roughly to like close to this, which is essentially how many people are or cycling into that. I was a chemical engineer, more specifically a reaction engineer, which was a subspecialty. So I did reactions and catalysts were my specialties. So reaction economics and reactor design were things I also specialized in school. Up to 6 months in PA. Oh, okay, cool. I did research for a few years, and I also taught at the University of Houston for a little bit. A little funny story. I went out the other night with some friends, and a friend of Nicole's, friend of a friend of a friend, was married to one of my students, who was like, Matt? I was like, oh my God, what's up? So, back to talking to some of these things, right? So the numbers here on these unemployment claims, or sorry, jobless claims, is the number of unemployed people who qualify for benefits. This is total, right? So let's look at the change each time. So, right, this is 6 plus 60 minus 13. So essentially the number of people. So actually, let's go this way. Minus 16 plus, this is going up in time, right? Were you an engineer, bro? DK? Where my engineers at? You know, Rock Scooter, literally most of our members from the starting like foundations of where we came from. We started with 3 engineers that kind of made our original club, the Paradise Group. We were like started by 3 engineers, a mechanical, a chemical, and actually an audio engineer. And we always said he was the smartest of the 3 of us. He's the guy who gave me a phone call to be like, hey, is your mic upside down? And I'd look at my condenser mic and be like, holy shit, how do you know? He's like, I can just hear it. It's like, bro, let's go. Okay. Market's pulling back a little bit. Easy to see that. But let's go back and look at some of these numbers. This is the total number of people qualified for unemployment insurance. The number of people that filed for the first time in the past week. Okay. So if you imagine a 3-month period, you can sum up the 3 months and that would equal that. And some places are going to be, you know, people are going to get their jobs. If there's the total here in a 3-month period is greater than the total number of people in a 3-month period in the other one, you can say that people are on unemployment for a little bit and then got their jobs back, right? So just kind of looking at the numbers, you're getting, as of lately, more and more people continuing jobless claims, right? So it means that it's becoming harder for them to find a job, right? Because they're on unemployment for longer. You're seeing that. And that's over the last, this is last week, week before. So that's 1, 2, 3 weeks ago. And then this is the new one. This is an expectation going into tomorrow. So again, it's stabilizing, but still more people are still on unemployment. It's harder to find jobs. And this is what the expectation is telling us amidst job growth. So companies are creating jobs, right? We're showing that it's harder to find a job, right? So companies are creating jobs and being pickier on who they're going to find. But the available workers, there's more of them, and but jolts are going up. So one would say that with more available people in the unemployment pool, why are they not getting those jobs? Well, it's because they suck at their job. Their resumes are bad. What'd you do last year? Where's your letter of recommendation? Oh, you don't have one? Oh, your company fired you because they caught you doing nothing and getting a pay. Oh, yeah, we don't want you. Oh, you're asking for too much money. One of the two things. And it's probably the latter. Either A, they suck, no offense, or they just want too much. Why do they want too much? Not because they're greedy. Because they can't afford their house. Because they bought it because they're an idiot. What up, Paul? Does that make sense? They want too much for the job. That's probably the problem. They want too much money. Why can't these people get those jobs? New jobs, more people needing jobs. Why can't we connect the two Why does the company not want these people? For one of those two reasons. They either suck, or and not even suck, but maybe it's like it's sector, right? It's like not the right competency, or like lacking competency, which means this may be programmers, and these may be, you know, I don't know. What's another job? Teachers, whatever. Like there's the dissimilar competencies, right? To dive into this one, you'd have to look at what jobs they are, and I'd actually have to go dig on the U.S. Bureau of Labor and Statistics data to see what kind of jobs are opening. Like, I know, for example, being a software developer myself, my developer, it's really hard to find developers right now. My developers are asking for raises in midst of this because they know the demand for them is high, and they know they can barter with me for that, and they know they're going to win because I'm desperate for their work, because it's hard to find good programmers, right? So a lot of available programming jobs there, not a lot of programmers. Create wage growth. I know, because my programmers are pulling power plays because they're smart as fuck. They built Rocket Scooter. They're fucking geniuses. Of course they're going to argue for more wages, and I'm going to pat them on the back and give it to them because they deserve it for being so smart to do that. They know what they're worth, right? And workers have poor expectation wages, and that's basically it. So with the similar competencies, or like lack of that type of work, you need to hire teachers, and all you have are pilots. Well, it's going to be hard to fill those jobs too. This is probably a big part of it, which means that the job growth is isolated to a few sectors. We should investigate that to see what's growing, right? Earnings will kind of probably tell us what is growing, but we probably should investigate a little further. But still, this environment doesn't mean everything's growing if I look at it like this. And back to the first-time jobless claims, this is just showing layoffs in general, right? So the number of people laid off, so layoffs, right, we're going to go +1. Actually, this is, I'm just doing it in thousands. -15, -5. But we're expecting +15. So for a little bit, right, fewer and fewer and fewer people are getting laid off, and now more people are getting laid off. So this is job growth partially, and partially because people are getting laid off. So it's a mix of the two, which also points to the idea that labor is in spot sectors. So of all the jobs that are available, some of them are created, some of them were laid off, but still open. Which means that some sectors are bad. Some sectors are bad and are just laying people off, whereas other sectors are growing. Growing. Do y'all see that? It's mixed data. More people getting laid off, but more people finding it harder to get a job. So the dissimilar competency means the job growth in some sectors is outpacing the workers in some sectors. Other places, people are just getting laid off and the job's still open. And again, the dissimilar competencies is making it harder for them to find the employee for that job. So what that means, ladies and gentlemen, is we're in a period of stock picking where some sectors are going to do good and some sectors are going to do bad. Let's prove it real quick. Let's look at some spiders. Give me some spider tickers. Let's look for XLE. And okay, let's just look some daily charts. So we're probably going to see some sectors trading low and some sectors trading high. Oh yeah, I'm gonna let DD. I'm gonna buy Fed maybe at the bottom, but honestly, with things trading down, Sam's gonna kind of sit on the sidelines till the end. All right, let's go. Energy has been rallying, right? XLF. XLF not rallying. It's dipped in the middle. All right, I'm not gonna run through all the I'm not gonna run through all the 11 sectors, but let's spread it out. Let's look at utilities real quick. Things that I know are trading down. Look, utilities trading down. Right? Real estate. Let's do, which is XLRE, I believe.
I'll get that right. Real estate trading very low, but this week trading up, right? So you are seeing some very, very, very sharp sector deviation, right? So let's look at 2023. Real estate's going up. Okay. Again, since 2023, XLU. I'm just going to prove that it's exactly what we said. Utilities trading down. You can see some major differences. And let's look at energy. Again, 2023 been trading up. So there you go. So what it means is some sectors are more efficient in the recession than others. Congratulations, we solved the puzzle. So in general, the market's going to likely behave bullish in some places, bearish in other places, which means overall the market's going to be flat. Wow, what a long-winded answer to say that in general, right? So it's pretty cool. And so let's just go ahead and just look at the SPY. Now I'm just looking at 4 of the 11 spiders, but let's just go ahead and just say, wow, it's a flat market for the last year. Congratulations, you guys are a bunch of fucking geniuses. We did it. Pats them back. We'll chill, you know, look at it. And you can see right now, the perception in the short term is that that metric that we looked at this morning is slightly bearish, right? Because you have people, you have jobs opening on the surface and people can't get those jobs easily, which means that dissimilar competency, the one worker that goes in can ask for a higher wage. And ladies and gentlemen, that is why those jolts expectations, jolts up, continuing unemployment down, first time unemployment down. Sorry, got that backwards. Somewhat up. More people, more jobs. They can't get the jobs, which means there's some kind of block causing that to happen, which means that one worker that's perfect for the job, he's now going to ask for more wages, which means inflation is likely going to, with all things being equal in production, the economy, inflation's likely to have a second smaller wave up, not a bigger wave up, but smaller wave up. And let's just double check the CPI expectations, right? Hold on. We'll solve the problem there. And then we'll see what we think the Fed's going to do. I'm using the Rocket Scooter platform, Paul. Check it out right here. There's a free trial. It's 7 days, no credit card. Actually get in, log into it. We're going to do a little demonstration of it today. Rocket Scooter shows you market maker positions and a whole bunch of other cool tools. Is the first in the world to do. Show you institutional positioning, market maker positioning, and hedging. We're going to show you arbitrage in the index, other really cool things. We have a stock scan, sorts for your trade plan. Kind of like an emerging trading platform. And just check it out. It's about to close the stream down, probably about 10 minutes, but we're going to go to a Zoom call and we'll come back live for FOMC. So the CPI expectations are expected to be flat, and that's exactly what we're thinking, right? It's a neutral shift. You have jobs opening in some areas, people getting fired in other areas. So some sectors are growing, some sectors are trimming. The neutralization, you'd think that some of the wages or some of the workers that get the jobs are going to be asking for more wages, but it seems like there's enough people getting laid off in other sectors to pull those wages down. So some sectors wages up, some sectors wages down, which means the wage-induced inflation is probably expected to be somewhat flat, and the forecast is expected to be, look at that, flat. You guys feel like a bunch of geniuses. 6.5 last month, and it's 6.5 this month. Go figure. Again, puzzle solved. Some sectors are getting wage inflation and high demand for workers. Other sectors have so many workers, they're firing people off and lowering wages. So the net effect on inflation is no change. So therefore, no change means not getting worse. So not getting worse means the Fed doesn't need to press a little harder on the boulder that's on the edge of the cliff to get it closer to the edge and crash the market. So because it's not getting worse, the Fed is not going to get worse.
So 50 basis points last time. There's almost zero chance we'll go above it, because if they're trying to control inflation, inflation's pretty chill, right? Now, again, while we'd like to see all sectors lowering wages, we're not seeing that. We're seeing some go up and some go down, which means flat, which means the Fed still has some work to do, which is why in the summer, round 2 of inflation, Fed's going to come through. Now they sprayed the edges of the yard with the pest killer. They're going to come through and like douse the center of your backyard and deluge it round 2, which is where I get my 1 to 3 basis points, 1 to 300 basis points during the summer. Whatever sectors are booming right now with wage inflation, whatever they are, the Fed's going to have to come down and really shock them too. And guess which industries those are? Fucking oil and all these other ones, right? It's like the Fed got the layoffs in some places, but other places are very resilient because of the shortages cause that raw material to go up in value. And you got tons and tons and tons of sectors that are booming right now, and they don't even care. I know people that tried to quit their job last year and their company tried to bribe them with like half their salary to stay there in oil and gas. And so you have to understand that rate hikes aren't over, but they're over for now. Do we get it? So because of that wage deviation, some sectors are booming. Here you go. Check this out. They're going to continue to inflate and inflate and inflate, and eventually they could cause the overall economy to start booming a bubble again, but just in a couple sectors that are going to take over. Let's look at consumer staples, because that is also a problem. That is the XLP. Again, booming, right? Staples being, most of your foods. You're going to know that consumer staples, you've got like all your, I don't know, your Mondelez, Smuckers, Colgate Palmolive, Cisco, Kraft, Hormel, like all those companies, right? Food shortage, you're dealing with that right now. So food industry is booming. I'm going to say healthcare is likely. Let's see if healthcare is still doing what it was doing. Yeah, it's still booming. So again, there are certain industries that just aren't feeling recession yet. So rate hikes are going to pause for now. But remember, you might have killed all the chinch bugs in your yard. It's a Texas thing. I don't know if you guys get chinch bugs where y'all live, but you still got ant piles everywhere that you got to deal with later. So since in general, the Fed can't really control all inflation now, as the further they push, the more problems they're going to create in like healthcare, right? Healthcare is a big part of the NASDAQ. Energy is doing crazy. Staples are doing crazy, but other things are doing bad. So essentially we got like, in 1 year of QT and rate hikes, we're able to like rally up half of companies and put them in control. We got to lay off the appropriate amount of people in about half of the companies. The other half, they're booming, right? And the shortages are there. So we can't force the ones that are doing great to bubble up by pushing way too hard too fast. We got to let these two things somewhat stabilize, and then once they start to grow again and this one stabilizes, the FOMC is going to come back in the summer after a couple of rounds of earnings just to see how these booming companies are, and they're going to nuke Wall Street one second time to slow down these rallies, which is not going to crash them, but the stuff that's doing bad is going to catch up, and there's your S&P to new highs if we can achieve that. I'm trying to think like Powell would and say that it's going to take a round or two of earnings for them to see the effect of the stuff that's booming that should also be laying off. Since this to just prove that layoffs are in a spot, couple of sections. It means that rate hikes aren't over, but they're likely over for now because inflation is stable. But it's not a good stability. It's like, imagine you have a seesaw that's just sitting flat. Okay, but imagine you have a seesaw that 50 people are on one side and 50 people are on the other. It only takes 5 people to jump off to really tilt that one way or the other. So you don't want something that's half of the things are really good and half things are really bad to make it balanced. You want everything balanced, right? So it's going to still mean more rate hikes. It's going to mean no rate cuts for a long time. And you're going to need to see like those areas where there's food and energy shortages start to stabilize. And so that means like after right now, I think we might go to 25 basis points and 0 and 0 and 0 and 0. So that the companies that are bad can start to recover, and then these are going to start to recover, and then they're going to raise rates 1 to 2 or 3 points to really, really, really shake that up and flatten everything out. It's a twofold process. So now we're going to predict rate hikes. Ready for this? Quote me on this. We got every single one of them right since last summer. Every single month we predicted it. A month in advance, mind you, not the day before. January 25, February 0, March 0. April 0, May 0, June 0, July maybe 50, sorry. Wait, hold on. January earnings, February, March, April earnings, May we might start ramping up again, and then July forward 1, 2, 3 plus per meeting. And at that time everything should be rallying, and if I were the Fed chairperson, that's what I would do. I'd let Wall Street get comfortable for 2 quarters. I'd let the stock market be flat because the sectors are doing that. And then I'd let everything start to improve as shorts get squeezed and markets just recover and recover and recover and recover. Then I'd come through and start slamming with rate hikes. But the good recovery and good economy is still not going to crash that market, and that volatility would subside. And we're out of the recession by quarter 3 if all's done correct. So I'm excited. I'm tired of trading this fucking bear market. I want to tell you, Papa hates it. Although Papa's also up 12%. Oh no, wait, 11. I don't know. Wait, hold on. 11.2% on the week for the account. Not bad. Let's trade some Fed. Back to SPY. I love this, right? Economics lesson. Did I get my degree in economics? No, I got my degree in problem solving, which is what an engineering degree is. How do you solve a problem? Well, you look at the data and you find relationships. And it's not hard to do that because it's mostly like an A/B comparison. We're not doing like advanced math, advanced calculus, or anything crazy. We're just looking at trends, right? Market's very sensitive to employment numbers right now, especially employment in certain sectors. So that's a problem. You work in oil and gas, you got 5% raise and 20K bonuses. Oil and gas is bribing people to keep their jobs, aren't they? I'm telling you, there's sectors that don't feel a recession right now, and you can see all that in Wall Street. If you guys like what you saw or what you're hearing here today, you know, in trading, it doesn't take a genius level economist. Don't consider me a genius level anything. I just do my homework. I'm always chewing on the stock market, trying to figure stuff out. I always do my homework, and the homework's not that hard. What makes homework hard for you guys is because you don't know where to go. And you listen to people that just come in and they say, looks like inflation's going up. But wouldn't it be cool if 6 months before that, you were showing that inflation was going up with the data that we showed? Right now, we're showing that inflation's going up in some sectors and going down in others. We proved it by looking at those sector spiders, but we actually looked at it months ago. And we're saying that inflation was kind of tapering off, like CPI numbers are coming down because markets were stabilizing. The Fed achieved their first round goal of inducing some layoffs. But the further they push, the more problematic they can be because they may push into other staples and energy to force layoffs of crucial transportation workers or crucial gold miners or, you know, crucial oil rig workers or people needed to get the oil out of the ground or or harvest the eggs from the chickens. You start laying those people off, those shortages make those wages go up, the shortages make those products go up even higher. And while it's not a wage problem, it goes back to the original COVID problem, which is raw material shortage, which again can have a reverse effect on inflation if you start laying off people in the wrong sectors. So they can't push too hard to create that effect. You would have Spaceship said should have loaded up on Transocean in September. Dude, me and I remember back in, so you know, I'm a speaker for The Street on their podcast, and they're about to get that started again this year. But I remember back in the day, me and Sarge and Ashton had a conversation about Transocean. I remember back in the oil collapse. It was in the shale gas collapse back in the base of let's go back to, or was it 2016? At the time of here, when you looked at the open short interest of stocks, it was the most shorted stock in the entire US stock market. I remember that way back in here. There was no stock that was more shorted than rig. I remember back at the beginning of the year, Sarge just talking, or at the end of last year, Sarge just talking about that being one of his bigger plays. Kudos to him. That thing is hella booming. I think he said he got in at like 3. What's the plan for Fed trading? I'm probably just gonna chill. Going to the Fed, yeah, we'll be live for Fed. Y'all want to stay live or what? Has anybody here gone through the free trial and wants to go through an extended trial a second time? Who hasn't signed up for Rocket Scooter yet? You gone through the free trial, you're like, okay, I liked it, but you know, I don't have, you know, I went through my free trial, but maybe I want another trial. Who wants another trial? If you've already gone, now if you remember, if you've gone through the trial but didn't sign up, I want you to go to our Discord now and send me a message. I'll give you guys an extended trial. Fat Thor, you think we had a bottom on SPY today? Not yet. Brandon thinking about going heavier on puts, but you have some calls in there as well. On Transocean. You know, that's the thing, right? Do we think there's weakness in that industry? Good question. I'm on the fence. Longer term, possibly. It's how sensitive they are to like the rate hikes and global economic things. We're going to get into any kind of shortages. Of course, very also heavily related on OPEC stuff, right? The value of oil. So there's a lot of mechanics there. It's really hard to come up with an idea that. Kyle, what's up, bro? That's correct. Lewis, you guys are correct. So, now we're getting very close to, what is it, 10:30 right now almost? You guys are so smart. I love y'all. Okay, so in this mode, yeah. Right here. Mode 1. It's res greater than 0, less than 0. Here. Mode 2 is outside the band. Res greater than 0 is support. Less than 0 is resistance. Absolutely. Absolutely. But remember, you've got bullish positioning here. So your bull support is here, your hedge support is here, and you have a liquidity pocket there. So the middle is like preferential, and that's where we are right now. Like, I think the market's going to stabilize in the middle. I'd like to see Fed create some kind of effect and push the market lower. You know, a catalyst is going to supersede DD. That rule of hitting that upper band, remember, requires the markets to be rational and stable and non-random, all that stuff. Those are actual rules we have to sit out, to not trade, to do other rules that we have that are basically risk management rules. If y'all like my post last night, I'm going to put a little risk management module onto the side. That's going to have all of our rules in there, if y'all like that. Oh my God. Dude, somebody's memeing. I can't play it because I'll get copyright copy struck. Hold on. Somebody posted the Charlie meme. So I actually wrote in here, like, basically they took my chicken scratch right here. And somebody was like, wait, what's going on? I just put that there for my So Charlie's like, Pepe Sylvia, Dennis, did we gotta talk about the mail? If you know, you know. My favorite. Kron, you need that extended trial. Okay, if you want the extended trial, go to Discord. Hold on one second. Do this really quick. We'll hook you up with the extended trial. It's gonna be like, I want you to do this. Go to the Ask for Help channel and say extended trial. If you want the extended trial, and then one of our mods will get you the link for that. The extended trial will be for 3 months instead of 1. Give you a little more time to get into the program. And then there's a link. And here's our Discord, guys. So we're gonna chill. Looks like market's bumping up against lower resilience, which is good. Again, pre-fed. Do I want to do anything? Probably not. Just tested expected volatility lesson on SPY. It works. Oh, dude, I love it. I love it. Okay, let's do a monthly map really quick. Probably not until noon. What are we gonna what? Pre-FOMC trading. We're gonna talk about how to trade the FOMC today. Yeah, I think that's. Y'all want to do how to trade the FOMC, guys? Mm-hmm. I'm working at the, I'm looking at our single date. Yeah, so I'm trying to look for, what's today, the 1st? So single date on SPY, Thursday, Friday, Monday, Tuesday. So we're not getting the single date pulls for SPY. It's something going on with the scheduling. I think the 17th, 24th, 3rd. Okay. Alrighty. Hang tight. Okay, we'll do a quickie little lesson here. Alright. Message my guys here real quick. All right. Volatility lesson. Let's go. Let's look for some stocks. We have Meta. Let's see. Meta's still getting like really weird hedge pressures. This has to do with our data provider. This is just it's Meta went through the name change. Our data provider just never, there's an indexing problem they've had. They've never fixed it. So Meta has expected volatility that's really large going to earnings. Let's do like an Apple. Let's do this lesson here. Let's do a monthly map for Apple. Okay. So once we get monthly maps in here, it's gonna look just kind of like what you see, like with the with the boxes like this. And what's gonna be cool is that it'll have a it's like a daily chart. Is what we'll have, like our monthly map will be drawn on a daily chart. So it's like, let's take a look at Apple and we'll just kind of do a quickie little monthly map on it. I love these setups here. Okay, let's do like for Friday. 142. So we're gonna look at Apple going to earnings really quick. Do you guys have any cool Valentine's Day plans? Any y'all taking your honey bunnies out for V-Day? I'm going to a fun little gala with some Houstonians who are in Rocket Scooter. So you guys are wanting to go to an event. I think it's Friday. Just a little beat up, just for fun. If you want to do a couple date with us, well, it's not really a super expensive event or anything. Get yourself a ball gown or a tuxedo, and y'all are Houston fam. Let me know. I'll let you know where we're going. Okay, let's go to single date. We're gonna draw out a monthly map. I was hoping monthly maps would be done this week. They're having a meeting right now on the API that we need to connect to another one of our development teams that runs the calculations for walls. Our stuff is kind of like our server infrastructure is very complex for a reason, but that meeting's happening right now. So monthly maps aren't available and won't be available this patch. They're doing some other things first. And it's only because the API that we need to get the data that pulls all that data in one gulp in that calculation. You know, currently we pull all that data in one gulp, you know, for the daily liquidity maps. But to get like a monthly map, we have to pull out like multiple dates in one gulp. They just, they're creating that training right now. And now the data's pulled. And so actually, as we speak, our head of development, since I'm in here with you guys, our head of development is in that meeting for me, so he's gonna train me probably tonight or tomorrow on it. And so while they're working on that, that's basically the precursor for us to display the monthly maps. They already have a lot of display work done. They just need to be able to pull that data. I mean, actually, this is for the 7th. Hold on, wait. Let's go ahead and do this right. Manual, Apple, 10th, 36 and 20. It's going to basically draw your maps just like this. Okay. Because we're gonna just basically gauge Apple going to earnings, Apple going to the monthly as well. We're gonna do a little trick we did yesterday. Did y'all like that lesson yesterday? Wasn't that so cool? Did y'all have fun? That was it's a really fun, it's a very fun lesson on predicting volatility, right? So we're gonna do that really quick. Apple 120. Okay, we don't like to look too far beyond monthly, because monthly is kind of like that big. So as you see, this is going into this week. Apple's not expected to be super volatile, which is interesting going into Friday. Wait, hold on, wait. Let's do single date. Let me start over. Don't let me lie. 144 and 140. Oh, my bad. So not really too bad. 5 points of volatility. I need a new playlist. I love these like new copyright EDM playlists, but I also hear and listen to the same music every day. Okay, so on a monthly map on Apple, right, the volatility is expecting to get bigger and bigger as the weeks go by. We have, let's go up here. We have earnings this week on Apple, which is somewhat volatile. Obviously, the range is greater than the daily range of Apple trading in general. Next week, there's even more volatility, and the week after, there's more volatility. So it's interesting to see that we have an even higher expected volatility going into next week. I wonder what that's from. Is there anything big coming on in Apple? Slightly large to go from 120 to 132. It's a pretty big, large range. So what we talked about yesterday, so interesting to see, but you know, like the stock market is still relatively bullish with lower lows. It means that it's more, if people are willing to buy lower, it means they're becoming more bullish. And if people have to short lower, it's also becoming less bearish at the same time. It's neat to see. Rock Scooter shows you that. This is that monthly map. I just kind of drew it on here. And again, with DD being, you know, positive, I'm expecting certain stocks to support down here at the bottom. iPhone demand numbers. Oh, that could be it, right? If those are, when are those coming out? By the way, so if you can do me a favor, Quran, Fat Thor, those of you that were talking about getting the trial, go to that channel. I'll hook you up with that real quick. Ooh, it gets hot in here. One thing I love about having such a kick-ass computer, have y'all seen my computer? Is that it heats up my room like crazy. Oh, Karan, I didn't know that was you on Twitter. Oh. Thanks for the retweets, my dude. I never knew that was you. I was wondering, I was like, I didn't know who that was. Yo, what's up, Ashton? I was wondering who that was. I was like, is that just a... I thought you were someone else for a little bit. That's cool to know. What'd you miss? Day 5, 5-day streak. The 10,000 account is now at 11.12, 11.2. So I'm about 11% up in futures. Haven't lost a trade yet. Over 60 trades maybe. So this streak's got to end at some point. Streaks never win, but just talking Fed. We talked today. We're predicting that the Fed is going to likely taper their rate hikes to 25, then probably 0 for a while. And then I'm wondering what I'm gonna eat for breakfast. What'd you do? What is the trade view chart you have on the side? Mansoor, right here. This is all inside of the Rocket Scooter platform. Oops. So which chart? You're talking about the main chart or this little chart here? You have multiple T-Burn, you have multiple monitors. The extra heat gets great in the winter, but the summer it's a struggle to keep the office cool. I know, and I can't open the doors because I have 2 kittens. They come in here and scratch at my green screen. So basically I've been sleeping at night with my window open down here, and I come down and like it's super cold in here. The little chart is resilience. So it's the same as resilience here, but it's not locked into the time frame. Anything on a candle duration chart, this is like, for instance, 5-minute chart. This is 5-minute snapshots of resilience. This is resilience updated every 2 seconds. So this resilience right here is very tradable. I basically look at this one when I'm trading because it's tick by tick. I can see the history of resilience. Well, actually not tick by tick, but basically every 2 seconds it's a snapshot. This would be every whatever the best duration 1 minute. So it's a faster acting resilience, because resilience is one of the 3 major things we have here. The 3 indicators that we have that are the biggest, or I say indication that we have on our chart. The indication of DD. I don't like to use the word indicator because it implies technical indicators. So the DD indication right here is the number one things we have. Resilience is like one of the number 1 things we have. And liquidity map. These 3 things are your trio. Those are the 3 things that make every single trading decision of mine when I decide to trade. If I'm in, if the market's rational and stable and not random, then I use this, and this for all my pivots. That's it. And so to give you guys a little tour, liquidity map, if you type in any ticker, will give you some letters. I match letters to letters. This liquidity map is available, so you go get it, go print it out. This is my cheat sheet. These are flashcards. I base all of my decisions off of my pivots here and here. This justifies and strengthens my decision. This is my bias. This is showing me what the stocks are doing relative to the index and giving me even further information to adjust my bias or get out of my trade. Today, my short was purely resilience based. T-Barn, y'all just some pictures. Go to the off topic in Discord. I want to see what some of y'all's computers look like. Multiple monitors. I have 8 screens. I've got 2 computers in one box. One computer has 1 screen. Another computer has 6 screens. And the one that has 1 screen also has a tablet, which is another monitor, which I draw on, which y'all get to see me draw on. So I got that computer being as good water cooling as it is, really just pumps all the heat into my room. It gets super hot in here. Cost of materials, watch the increase in sales. That's going to be what I think earnings, the metaphor or the saying of earnings, dude. I think everything's going to be like that. It's be a wash because cost of stuff is going up, increase in sales, and then of course we're gonna have increase in sales, lower margins, and it's gonna be just a battle in that same sense. What you do today, Ashton? Anything fun? You doing any trades today? So QQQ and S&P resisting resilience just as expected. Resilience being a higher priority in liquidity map. The way that this works, if you guys can see. Dude, you print out the liquidity map. I love it. That's dope, man. I love it. Is that a Buddha on your desk there? I can't see because it's so small. Or is that a Shiva? I can't tell. It's really small. Is it? Yeah, it's Hindu. I can tell if it's Buddha. It's Hindu. Is that a Shiva or is that a Ganesh? I can't see. Super small. Is it Ganesh? Ah, nice, nice. So I practiced yoga since 2012, and in my practice in yoga, I dove really deep into the actual kind of scriptural back end of actually the spiritual side of yoga and learned all about Hinduism through all of my training. I even went through a teacher training program just to get deeper into the practice stuff. So not only do I do trading, but I also work out all the time, and I also am a religiously practicing yogi. Y'all didn't know that. So we learned a lot about stuff. I actually read the Bhagavad Gita as one of my books I've read, and I always recommend people read that if you haven't. It's really good. The famous Robert Oppenheimer quote when they developed a nuclear bomb, the "I am become death, destroyers of worlds," is from that epic story where Vishnu is trying to persuade the prince in the book, right, and get him to do his job, and he takes his form with the multiple arms, like all the arms come out of his body. No, I become death, destroyer of worlds. It's like such a powerful. So Robert Oppenheimer said that when they invented the nuclear bomb, because that is such a powerful image in that book of a majestic show of power and how destructive it could be. And that I love that part of the book, by the way. So yeah, from the Bhagavad Gita. I always say that word wrong, but my Sanskrit, my Hindu is not so great. Or my Hindi is not so great. I'm a big fan of like all kind of like epic stories. Like I loved the Odyssey, Beowulf, like any kind of big epic story or poem like this. It's always just a good read. Stuff they make you read in high school. That's also a really good read. It's pretty dope. He has the liquidity map printed out on his desk with some notes. Love it. Yo, what's up, Matt? It's a platform. We're gonna match the flashcards, then we'll color bull and bear zones. Yeah, the flashcards need to match the platform. We're trying to move away from red and green for reasons of color blindness, and red and green is a terrible accessibility choice for all humans. Some people can't distinguish red and green, so it looks gray. So we're gonna settle on shades of gray because we're kinky like that. Thank you. Maybe 50 of them. We'll see. So just going on today, we're waiting for some FOMC stuff. You know, we got about 2 hours till that comes through. Live trading FOMC is pretty much easy, right? We'll go through the steps on how we do that. Bull long up on the flash card. Moves higher. Resilience less than 0 in mode 2 moves lower. So what I'd like to see is with the FOMC comes out, I'm really nervous about the response today. So the press conference is when you do trade. Resilience is going to be a big factor of what's going on. I might take a scalp if we fall to hedge pressure and recover, because DD is positive, which puts bull side as support, right? Y'all know how this works. I'd love for the FOMC announcement to come out and the press conference sell us to here, and I just scoop up the dip to trade right back to the middle. Res stays negative, right? The pressure in the middle, this would be great. I'd love to take a trade from here and here just to the middle and close. Do we all got it? It's super easy. Hold on one second. Yo, what's up, Sean? Okay, man. Thanks for the call. Appreciate it. Okay, thanks. Okay, bye. Had a conversation just now with one of my tech teams. So we've got like a bunch of groups that build Rocket Scooter and different pieces of it. So this was one meeting that we're having talking about the monthly map stuff, and just had a phone call there. How you been, Sean? What's up, man? Sound Trading Psychology. Feel free to drop your Twitter here, dude. Let people follow you. Sean Psychologist, works in trading, teaches classes on trading psychology. Super cool, dude. You been watching The Last of Us show? Dude, I am hooked. Super hooked. Same for SPY, hedge pressure below zone. I mean, it hits that liquidity pockets. It's random, so it becomes anybody's game from there. It's kind of what I'm looking for to go forward into FOMC. So let's just kind of like draw this. It'll be over trading, but I kind of like the excitement of doing something because I know it's going to be chaotic and random. We have to make sure that I'd love for us to trade lower into it so that we don't get a 30-point drop on the catalyst, right? Or the event turn into a catalyst. So what I'd like to see is res less than 0, BLU greater than BLU and DD greater than 0.5. So obviously, like the sandwich today will be somewhere in the middle. I'd like to take this particular scalp if we get it. That'd be really nice. Because I don't want to give up the gains from today. I'm going to trade really small. Plus, if it's a big dip, I'm only do like 3 or 4 contracts. We'll see. We'll see how confident I feel when that market moves. So if we start breaking irrational in S&P, which is going to be what we end up doing, I might not do anything at all. I get scared of that. Let's put these. Let's prepare for FOMC. Okay, let's get a little more sophisticated on my trade plan here. And move that around a little bit. So right now, I'm not gonna do anything going into FOMC, but I'm gonna respond and react to that. Man, do y'all remember the last trading challenge? If you guys weren't here in the last trading challenge, it went on a 70-day streak. 70. That was 3.5 months without a losing day. I know it sounds crazy and that does not sound real, but it was real. There were thousands of people there watching it live on YouTube. The broker statement was posted 100 times on Twitter to prove it. And yeah, so I got lucky. I'm getting lucky now again, but also I'm not bad. I'm not too terrible at trading either. Yeah, Sean's got some dope stuff. Like, I met Sean on a podcast, and something that blends trading psychology, man. Sometimes you just got to have that Sopranos thing going on. You know, you got a job. Your job is horrible. Your job is terrible. Your job stresses you out. You're not, you know, being a mob boss, but you're certainly like killing your bank account every day. You're going to need to talk to, you know, a psychologist to start working on the mental game. Sean's the guy to do it, man. Sound trading psych. Sean's a good guy. Yeah, when monthly res comes out. Sorry, when the news comes out. Yeah, watching monthly res, of course. What assets do I trade? On for the small account challenge, I'm trading only S&P and Nasdaq futures, right? And that's just to prove pure trading skill. And something that's broadly appealing to everybody, right? Like if I just sat here and picked your favorite, I'm gonna do a trading challenge after this, and I'm gonna say you guys pick a stock for me every day. This is gonna be a fun challenge. I will let people pick a stock, and I'll have a bot read your chat and randomly pick one stock, and that'll be the stock I trade for the day. I'll load it up, I'll use liquidity map, and I'll buy or sell options in it. That's my next challenge after you do the 100K. Does that sound fun to you guys? Literally, y'all are basically like a bag of Scrabble tiles, and I'm popping out 3 random letters, and I'm gonna trade whatever it ends up being. So if somebody says Tesla, then that's what we're looking at. If Tesla has a play, no, I have a play. So I do different things. I trade options, I trade stocks, I trade futures. The futures challenge, right? Trading the index futures are the most traded, one of the most traded instruments on the planet. Any index product is the most traded instrument on the planet. And so being that it has the most level of sophistication with the highest volume of traders, if you can win, like Frank Sinatra said, if you can make it in futures, you can make it anywhere, is true. If you can beat everyone at the big game, you can trade anything else. And so it's a flex, right? I'm gonna trade index products against the strongest, the best traders in the world and beat them at their own game. I'm not going to gimmick it with penny stocks or gimmick it with crypto or gimmick it with the pump and dump or gimmick it by getting lucky by being long the right stock at the right time for the right news event, and boom, there's a challenge. I'm going to scrape together with a risk distribution, like drawdown limit that I'm setting for myself, position limit I'm setting for myself to grow the account exponentially as we get bigger, the position size gets bigger, which speeds up the growth. I'm at a net lick divided by the contract cost is going to set my position size. So right now I'm currently 11.2 is about 10 micros or 1 mini. Every 10K it goes up another. So at the 50K mark, I'm trading about 5 minis. At the 20K mark, I'm trading about 2. I'll stay in the micros world until I get to about 20. And I'll probably start putting 1 mini and then 10 micros just to have some granularity on like my position size. Can I share my feed setup on Financial Juice? Oh, hell yeah. The Financial Juice is awesome, by the way, if you've never used it. Again, this is not trading advice, not stock advice to do anything, buy or sell in y'all's accounts. It's just me taking that transparent stance to say there's nobody on YouTube that's fully transparent in a real account. And we wanted to show that you can see the account balance, the account number, the positions, the size, the trades, everything in real time. No editing, no camera tricks, no garbage, just straight up trading. You can't argue with the results you see. Financial juice. Here is my settings. I love. Okay, let's go here. My news. And I don't really have too much. I keep it pretty tight. Bloomberg, economy, stocks, commodities, worldwide markets. Forbes headlines, Forex Live, just their blog. It's a pretty good blog. It's a news blog, so they get a little bit of everything. Market Watch, top stories, and then Wall Street Journal updates. Also, they need to change the rocket scooter, but anytime I go live on my YouTube, you're more than welcome. That will show up on your Financial Juice feed as well. It's still under my Day Trader Paradise. I'm not sure if that'll actually show the rocket scooter. I need to get them to change that. Financial Juice, literally the best news aggregator on the planet. So you don't get better than that. They're awesome, man. I love that stuff. Jasmine Kumar says, can you hold ES or MES until their expiration date? Actually, it's called the last day of trading, and you can hold any futures contract until the last day of trading. Each futures contract, you'll need to look at its specifications. The contract specs, which is on the CME website, will tell you what the last day of, it's physically called last day of trading. So I'll give you an example. Let's go to CME Group. Jerry, you do that? Okay, here. CME Group. Let's see, maybe data? No, markets. Reference. Let me clean off my chart here. I wonder if I can get the contract specification. Let me just Google contract. I know I'm digging for it. Let's just Google contract specification. Great. Not the education on that, but the actual list. Oh, it is under energy. Okay, so it is under the markets / equities. Here we go. Oh, honestly, I haven't really changed too much yet. Actually, my settings are in. You have to, if you watch the pre-market video, my settings are somewhere. It's in the Discord and also in the video. It'll show you in those in the old videos. I think it's got my pre-market checklist. Well, I'm trying to figure out what these contracts are. Units are not far enough. Quote settlement specs. Oh, here we go. Here it is. Had to dig for a little bit. Well, also, the settlement price, what it's called, is the last 15 seconds of trading. It's the VWAP of the last 15 seconds between 3:14. Sorry, the last 30 seconds of trading. 3:14:30, I think, to 3:15 o'clock. Or I'm sorry, no. I'm confusing. Let's go here. It'll tell us what it is. Settlement procedures. So, if the lead month contract trades on Globex between 2:15 and 2:45 Central, the settlement period, then the month settles. The volume VWAP of the trading during this period is 30 minutes. If no trades occur during the Globex between 2:15 and 2:45, the contract settles the last traded price, validated against the bid and ask. If there are no trades, the contract, blah, blah, blah. Settlement validated against the bid high during the closing range. Wait, that's Bitcoin. Am I in the wrong? There it is. Not Bitcoin. Oh, it's BTIC. I'm sorry. I'm like, I need to put my glasses on. I'm like, that's... Am I looking at Bitcoin futures? I thought it said BTC. Okay, forget me. Forget what I said. Here we go. So the second month, right? When the lead month is the expiry month, then the second month is defined as the calendar month immediately following the lead month. When the lead month is not the expiry month, then the second month is defined as the first expiring non-lead month. If there are no spread trades between the last 30 seconds of trading, the last spread trade price applied to lead month settle, blah, blah, blah. The second month contract will settle to the VWAP of the lead month, second month spread between these 30 seconds. And that's how the second month settles. So the last 30 seconds settles the second month. Remember, the future is very complicated how they do it. The lead month, also, if no trades in lead month occur between here and there, then the contract month settles again. The midpoint between 2:59:30 and 3 o'clock. If the VWAP of all trades, in the 30 seconds, the settlement period will be calculated for the designated lead month and rounded to nearest tick. So if something isn't trading in those 30 seconds, then this is how they calculate the lead month. If there's no liquid or two-sided market or a market-made market available, then they use that particular thing. So your lead month will settle as the VWAP of the last 30 seconds of trading for the equities market closes pretty much, which is this time period here. And the second month closes on that pretty specific thing. Now, how far you can hold the contract in final settlements, the last day of trading on these things. Let's see how far you can. Let's go back. I forget what time you are closed out on by your broker, but your broker will dump your futures contracts for you by some procedure according to your broker, usually before the last moment of trading of each contract before it's over. So settlement is calculated. It's not the last tick of the price. So when futures stop trading, an estimated settlement is immediately printed and then it's updated after the calculation's compiled and done. So the real settlement price typically comes out slightly later and it's released after trading stops. So you're not going to know the settlement price immediately when the contract stops, and your broker is likely going to close your trade out before it stops trading so that you're not forced into the terms of the contract. Retail brokers are not allowed to execute the contract in the spot market to acquire the oil or orange juice for you. They're just gambling instruments for traders, like a cash swap, and you're just closed out for the cash. And your broker will likely close you per your broker standards. Go read them. We'll say if you're holding on your contract, we're going to close you by noon or by whatever. So they don't let you, for a mechanical failure, accidentally be in that contract if their system locks up at that moment in time, then your broker's got to go call a tanker and deliver oil to your, to your front door. That becomes a problem. So they'll close you out on your own. They'll close out all your trades by some time before it stops trading likely, right? And your broker at their discretion are allowed to do that, and it's all in the fine print. So what you do is you go read what your brokerage agreement says with their futures, and they'll tell you, like, where they'll auto liquidate you, and all the auto liquidation procedures probably will state that or they get out. So termination of trading ends at 9:30 a.m. Eastern on the third Friday of the contract month. So the contract, as you see, trades at termination of trading is a different schedule than settlement. The S&P falls into, as there's trading on that Globex session, falls into that tier 1 front month category of calculating VWAP for that 30-second window. So there's your settlement period, right? And your settlement price is calculated after that. Then trading will end on the third Friday of the contract month. So let's say, like an example, settlements of the S&P. They're currently in the March contract. So not say when it settles. Calendar. So settlements on March 17th, which should be the third Friday of the month. Just walking you through some basic future stuff. So the CME group, while this contract settles on that day, for the actual settlement of the contract, not the daily settlement. So we talked about earlier is like that daily settlement that's printed. That daily settlement allows you to quote a spot price against the futures market by the closing settlement price. So I need my orange juice today. What did orange juice settle at? Oh, the market makers told me, okay, that's the contract value in the market. So I would like you to sell me your orange juice at that value, and use the orange juice seller can be like, no, that's okay. Or yeah, I'll take it, right? It's just it's anchoring the price once a day. Then the contract for the month is for that month delivery to anchor the price for that month delivery, and that contract expires. Every one of those obligations must deliver by the delivery date. So it's a whole different thing. You can order oil whenever you want. Do you need a reference price? Instead of both of you going and checking a stock chart, both of you can Google yesterday's settlement price when you and your broker make your deal for shit in the spot market. So here, go back to, this is not futures, just all these little details, people looking about futures. Your broker won't let you go that far. So if the 17th is the day this contract is expiring, right? Trading ends at 9:30 a.m. of that day, right? So your broker might force you out the day before or at some period before this. So CME won't let you trade it past this time. You go to the settlement procedure, see what the monthly settlement procedure is, and it'll tell you what that day will look like, right? Normal daily settlement procedure, okay? Final settlement. And this is the monthly settlement, right? Shall be a special quote of the S&P index based on the opening price of the stocks index determined by the third Friday of the contract month, again to that 17th of March. If the S&P is not scheduled to be published on the third Friday, the final settlement price shall be determined on the first earlier day, which the index is scheduled to be published. Right? Yeah, so I mean, like, if you're swing trading futures, I don't know what your goal is with swing trading futures. Normally with swing trade, like futures are so liquid, you can trade them all day long. If you're just trying to swing trade like a futures contract for like hedging something you have in equities, that'd be a reason I would hold futures multiple days. I wouldn't personally ever hold futures through an overnight session. It locks up so much capital, right? You have to hold the initial margin to hold your futures when the Globex closes. So like you'll get margin calls. Imagine you have like 10K in your account and the contract costs 15, but your broker gave you 500 margin. You got to have the full 15 to close the day down, or you'll get a margin call, right? You have to actually close down and open back up to sustain your broker margin. And then some brokers only give you a little bit of loan. They don't give you full, like TradeAbate's $500 a contract, but they only give you like 5 in the overnight at that rate. They'll give you unlimited in the daytime at that rate, but in the overnight they don't take a lot of risk. So it depends on your broker. Yeah, it's very complicated, right? If the primary market for a component stock in the index does not open the day scheduled for the final settlement, then the price of that stock shall be determined. So essentially, like, if there's 500 stocks in the S&P and one of them isn't trading that Friday for whatever reason, which doesn't happen, then the price of that stock shall be determined based on the opening price of that stock on the next day that its market's open. So the final settlement of the S&P would be delayed until a Monday if one of the stocks didn't trade on a Friday. So example, if the stock doesn't open in the morning on a Friday for whatever reason, then they'll use the following day, is what it's saying. The component stock in the index does not trade on the day scheduled for the final settlement, which begins the Friday. The price of that stock shall be determined based on the last sale price of that stock. Hold on. If it doesn't open on Friday, does not open on the day scheduled. So the stock doesn't open on the Friday. Now the other thing is the stock does not trade on that Friday, meaning that I'm interpreting that as if the market's open but nobody bought it, so there's no actual market price. So like item 2 is like if that stock is just closed for Friday for whatever reason. Item 3 is, well, it's stock open but you didn't have a single trade all day. There's no way to quote it, right? To add it to the value of the index. So they also will value that on the last sale price. So that could have been, it would be the day before. And then I get to calculate the value of the index and then settle that contract. It's complicated how they do it. Crazy, right? What you'll likely see, especially if you log into a platform like Thinkorswim or something, you will likely see that you've been recommended to roll over overnight in the previous session. So like that Thursday night or even sooner. I think a lot of times, I think Thinkorswim and some of these other platforms actually roll you over. Let me double check. Probably the night before. When do they, let me just see when they recommend. Go all the way back to the last rollover. Let's go see. Where's that green line at? So it looks like in the equity session in Thinkorswim on that Friday, between Friday and Monday, it looks like is when they do roll it over. So it looks like they are rolling it over on that particular Monday. So essentially Thinkorswim, you can roll whenever you want, right? But Thinkorswim, I'm looking at my chart, looks like on the continuous contract does roll it over between that Friday and Monday. So after that last day of trading, which is that Friday, it ends in the morning. But it looks like the actual spot contract, I'm sorry, the front month contract trades until the end of the day and probably a little more. Let me see what the December one looked like. I think, if I remember correctly, it trades until noon on the following Monday, but this could be old news and I could be, you know, dust off my stuff. Hold on. ESZ 22. Let's see if I'm right about that. No, it's Friday in the morning. It does stop trading then. Okay. I was wrong. I could be thinking about oil because oil had a different schedule. So if you go to like, and I'm just doing it right here, this will tell you the answer. So in the example of Thinkorswim, right? I went straight to December 22, and you can see that like, per that contract, specification, right? Trading stops at 9:30 Eastern, and it looks like right at 9:29 candle, right at 9:30 Eastern is the last moment you can trade it with Thinkorswim. So Thinkorswim is quoting it actively there. Now, I'm not sure when your broker will force you out of it in a Trade-A-Bait or something, but at least Thinkorswim is showing active market quotes then. So again, you're legally allowed to hold that contract up until this moment in time per the specs, right? 9:30 a.m. on the third Friday. There's your third Friday. There's 9:30 a.m. Your broker will tell you when they force you out. They might not let you hold it to the last minute. They may kill you at this minute, 10 minutes before, 20 minutes before, noon the previous day. They're all different. So it's up to you. When does a broker force you to roll? That's up to them. So there's your answer. I love going through these stuff. So it's like, how did you learn all this stuff about futures? Somebody's asked me in Discord. Well, reading, like all this stuff that I just said, I'm reading it live, and I just learned a whole bunch, right? So the more you read, the more you learn. I know it sounds very LeVar Burton of me to say, and take a look. It's in a book, and it's really true. If you like to read stuff, you're going to learn a lot, because things are very good at educating you. The CME group is so great at training. They have so many cool modules to learn from. Somebody messaged me, nice short scalp today. Thank you. Do you have any numbers on the win rate of resilience at half gap and hedge pressure? So we should do an actual back test. Not any... never did any calcs on the back test percent of half gap and resilience predicting or the MHP res at MHP. The assumption is that by feel of how I experience it, if rational, if non-random, 90s percentile, that HP, MHP, or sorry, that res. Because stocks will lead the index. So under those conditions, expected 90% success rate. Outside of those conditions, nobody can tell. Indeterminable. How would I play my challenge with options? Oh, absolutely. So I would do 0-day options. I mirror it like futures, right? If I'm willing to lose 10% of the account in a day, maximum, again, that's not what I planned for, but a maximum, then I would choose to lose 10% of the account a day in an option, which means I would choose 0-day options. And it's an all or nothing thing. Now, it's mirroring the same amount of gain or loss in the futures. Does that make sense? Now, again, you can do 0 days are an all or nothing thing if you want to not have that big of a hit, right? You can do next Friday expiration, or give yourself 5 days just so you don't take a huge hit and you maybe only lose 20-30% of your options price a day, and allow yourself to only purchase option 10% of the accounts. An example is at a 10K account, I would only buy $1,000 worth of an option For a 0 day, that 1,000 either makes something or it loses something, and that's it. SPY options are Monday through Friday expiration. So the 0 day availability is there for every day. Now, again, that's a very risky thing. If you're 0 day, I would say I wouldn't even spend more than $500 on a trade to 1,000 at most. If I'm willing to lose 5 to 10% on the account, then I'm willing to lose 5 to 10% on a 0 day. And the same sense of the risk is matched to what I'm doing in futures. So I would do $500 to $1,000 in a 0 day and trade it all or nothing. I would trade to my target and get out and close every day. I'd never hold till the end of the day because I don't want to take that last hour theta burn. So an example is if I'm shorting from A to B, I'm just day trading that option. The problem is that you might have problems getting in and out of those options because of the spreads. Depending on if they're out of the money or in the money. So you're going to lose a significant portion of your gain just escaping from that trade. So some people may hold that 0 day until the very end of the day. If it's winning, you're going to take an efficiency hit if you cut, if you're losing. So it's a little harder to trade options because of those spread mechanics, especially, you know, depending on the price of your option, how far out of the money you are, it'll be a little harder. But it's similar thing is that I would take the day trade from point A to point B. I'd open the trade and close the trade and then take whatever efficiency loss I would. And I wouldn't invest more than 500 to 1,000 at a time. And again, as my account grows, I'd lock out 10% per trade. So at a 20K, I'd buy 2,000 worth of the option. At a 30K, I'd buy 3,000 worth of the option. Does that make sense? So your position size will shrink as you lose money, which scales your risk to lose 10 days in a row and you blow up, which is really hard to do. To lose 10 days in a row. I mean, it's not hard to do. It's possible. I mean, you guys can do that. Very hard for me to do. I don't think I've ever lost 10 days in a row in my life since I got good at trading. Well, I mean, don't let me lie to you. I don't think I've ever lost 10 days. Actually, I don't think I've ever lost 10 days in a row in my life. Now I think about it. I don't remember ever feeling like I lost 10 straight days. I probably went through 10 days of losing a lot, but there's always a winning day built into some of those. But I try to make sure that something improbable is protecting the account. Like something, winning 10 days in a row is very impossible, but I mean, I might do it. But I trade very structured, right? Like losing 10 days in a row, a monkey could throw darts at a dartboard and hit the center 1 out of 10 days. You can literally flip a coin and get lucky 1 out of 10 days. The market either goes up or goes down. I mean, for you to guess wrong every single day is 1 over 10 factorial, so it's a 1% chance that happens, right? Or wait, not 1%, sorry. Right. 50% chance you lose 1 day, then 50%, a 50%, a 50%, a 50%. Actually, that's what it is. 0.5 to the 10th power, not factorial. The percentage of that is so small, right? .00098. So you're talking about 0.09% chance of losing 10 days in a row if you picked the wrong side on a 50-50 split of a coin flip, right? So probability is so small, and that's why I do it like that. 1/100th of 1%. That's really small. Actually, sorry, 1/10 of 1%. So again, I would allocate a small amount of capital, Michael, and just trade that and never go above it. So an example, if I'm making 400, making 500, or losing 500, give or take on my trade in futures, I physically cut at that. If you have a 0-day option that you paid $500 for, you either lose $500 and no more, or you gain something, right? So I would choose the very closest expiration to get the highest momentum or leverage on the trade while still maintaining a cash equivalent of my fixed loss if I lose. If you push farther out in time, you'll have less of the option and you'll get less of the gain, but the same amount of loss, and it'll cost more for the option. So an option further out in time will gain less % on the win for the 500 you invest. The lower R&R the farther you go out. So for day trading, as close as possible to now is the highest R to R. Your risk is fixed. It's $500, give or take. But the problem is the closer to now, the bigger the spreads can be sometimes, and you'll have a hard time getting out. So the efficiency you gain, you could also lose. But rule of thumb is a week out or less. The following Friday, if I'm trading a stock, the S&P, I'll probably 1 day out, if not 2 at the most. 0 to 2 days on the S&P since they're Monday through Friday. Next Friday for every stock, and 0 day on that Friday. And as Frick has said, for options, you stay close to in the money, even when more expensive. I 100% agree. That's the smartest thing to do. Buying those out of the money YOLOs were like 3 penny options to make it go to 12 or 15 cents by the end of the day. You'll still lose a huge chunk of that just closing the trade out if you want to close out for profit, because you're going to jump across a huge spread. Staying close to the money is good, but you have to be careful though on those 0 days, because theta burn is the highest at the money. So you want to be slightly in the money or slightly out of the money and not at the money. Keeping in mind that theta burn is the highest at the money, right? So you get a very good lack of a theta hit on 0 days. For instance, like right now, if I wanted to buy 290, if I wanted to buy calls in QQQ, I would either buy 295s or 293s. I wouldn't buy 294s. Does that make sense? Do you agree, Frick? Like, I don't want to buy something that we're dancing around it. I either want to get a slightly out of the money to have less theta, or slightly in the money for more expensive to also have less theta, because theta is parabolic around the money like this. So if you're like, I want to just jump in on the long, I would buy out of the money. These are cheaper with more delta gain. These are more expensive with less delta gain, but they're in the money. So your theta is like that. So as he says, stay close to in the money. Yes. Or stay close to out of the money to the same degree on the other side. Out of the money is a higher win rate for a lower probability, right? It's harder to go that far and go in the money. So the chance of you being out of the money is higher. That's why the option is cheaper. The in the money, the chance of being in the money is actually higher versus the out of the money. So the option's more expensive. And because of that, the delta change is slightly less because the probability is already high. You're in the money already. So take one, you know what I mean? Like the way that I trade options is very simple. If I wanted to short from here to there, like this is very simple. Trading options, the way I do it is super easy. Yeah, a lot of people, and I agree, I like to play out of the money as well. For 0 DTE and ending the money, and ending in the money has the biggest return. Yes. So closing out like right when you burp in the money. So an example is if I have a short setup here or a long setup here, then as the market hits my levels at this moment in time is when I'm going to buy puts for this trade. And so when you hit hedge pressure, I want it to already be in the money. So I would subtract one strike above, and I would buy, at this point, I would buy 293 puts. And the moment they go in the money, I'm Xing out right there. Does everybody understand that? That's how I day trade options. 0 day. It falls here, I don't do anything. I want to reject like I did today, like I shorted the S&P. At the same time, I'd buy puts and I'd have to say where I want them to be. Well, I have to determine my end target is here. So I want to be, when I hit that support, to be in the money. So I got to go one strike up. The same thing, if I wanted to long here, some area, well, if we have resilience negative and BLU positive, then the middle is here. At this moment in time, I'm going to buy calls and double down on calls right here. And when I hit the middle, I want them to be in the money, which is 293.50. So I'd buy 293 calls. So like 293.50 pretty much is the middle. When I hit my target, I want to be in the money for that little bit of a gamma burp, an IB burp. 293. Does that make sense? So here I'm buying puts for there. There I'm buying puts, buying calls for there. Yeah, okay, cool. You don't want to be, you want to be in the money when you close the trade out. You don't want your option to be on the other side of hedge pressure, because while it's dancing here near the money, your theta burn is going to be the biggest. So you want it to, when it hits its pivot, as soon as it's falling and falling and falling, you're going to get that neat little like put spike, right? Your premium spike. So as example, if you bought like here and you bought puts right there, as it's falling, your option is going to go, you know, if it's a linear fall, your option is going to speed up in price via delta and then burp up on that IV right when it goes through the money, become a little liquid, and start to stabilize as that IV is crushing out. So like right when you get that, like once you go in the money, like 1 or 2 or 3 big candles in, I'm dumping, and I can even market dump and get a good price. The extra burp you get usually compensates for like the loss you take from the slippage. So I trade the same thing. So in the options in the Discord, there's a strategy on how I trade my options. So on the liquidity map, it's tip to tail. And I'll just show you right here. Let's close all this stuff down. God, we've just been chatting all day for FOMC. So if I'm scalping from here to here, at the tail, I buy the call on the strike right below the tip. If I'm trading from here to here, at the tail, I buy the cheap put at the strike above the tip. Frick is throwing down some knowledge bombs. I like it. Prefer to trade out of the money for 0 DTE and ending in the money is the biggest return, because that's going to have your out of the money will have a low delta. Passing through the money will pass into high theta, but high IV probability of that sometimes is low, or just high delta gain. And gamma gain, as you strike through the money, you get delta plus gamma plus IV. Totally nukes the loss of theta, and you totally make money on the 0 days. The closer to expiration, the probability of them going in the money is lower. So your premium, when the probability of something's lower, the value of its result is worth more. So the closer you are to expiration, the higher the gains you'll get on the run. And that's why people do 0 days, but you cannot YOLO a 0 day with your whole account. You must fix your risk. I would say 5% is not a terrible idea for a day trader. Day traders are going to take a lot of risk, right? Now, stock traders might want to trade 5 to 10% a year holding stocks, which is pretty cool. It's like your vanguards, but day traders are a little more trying to make a career out of this. And if you're good, I would never risk more than 5% of your account on a single trade, like an option. Frick, do you have like a maximum that you do? I'll go at 10% because my win rate's pretty good. But if your win rate's really low, I mean, I'd say that like if you went 5%, you'd have to lose 20 days in a row if you're doing 1 trade a day. Now, if you're trading 3 or 4 different things, don't pile up 5%, 5%, 5% on 3 things. That's 5% maximum per day. So if you're trading 3 or 4 things, you want to divide that up 3 or 4 ways. That's my, again, not stock advice period, but don't risk more than 5% of your account a day trading. So on 0 days, so Frick is even safer, just likes to take his gains and amplify them with those 0 days. That's a little bit better. Yeah. Cool. All right, let's take a look at everything else in the market. Pretty much stable today. Resilience negative. Things looking booty. FOMC is coming out in 1 hour, so we'll just chill on this and kind of wait and see what's going on. DD requires non-random. I got a buddy of mine collecting stats on my indications to see if they're doing well and they're correct. So I like it. I like when people are... That's why I like to trade transparently, because like when people don't trade transparently, it makes it hard for other people to really gauge if something's worth a lot. You're really stuck with some shady salesman, paper trading, trying to sell you a bunch of garbage. Like trading transparently is like somebody is literally right now watching every trade I'm making a spreadsheet and trying to calculate the physical accuracy of each of my strategies so they can be reported to the public. And I'm like, thank God somebody's doing it, because I would love to see myself. Like, what's the stats on DD? What are the stats on resilience under like these certain qualifiers? And that'd be kind of cool once you have our backtest module. You can program your rules in Rocket Scooter, and the rules can set your backtest. So we're going to have what I actually created, this rules thing. You want to see something cool? All right, for those of you that are here, all right, don't show anybody. We're making a video game kind of thing. Like, this is just quick. So pay attention. We're doing this thing for your training now. We're building like a ladder, and this is, don't show anybody this, don't tell anybody this. We're building like a ladder. Remember, like, you play a game and then you like go through and you unlock something. All right, that's all I'm gonna show you. You didn't look, you missed it. Okay, one more time. Watch your video. Something's going to open up, read something, watch something, take something. And then once it forces you to watch it in order, and you can unlock a path. Are you a day trader, swing trader, investor? Video. Are you stocks, options, futures? Video. Like, it's going to take you down a path, and you unlock them one at a time, and it tracks your progress. You have to take a quiz to unlock the next video. So you basically are going to be forced to learn, which is kind of a cool thing we're building right now. Another cool thing we're building right now, which is like, if you want to watch the videos, people are like, what order do I watch, and this and that. Well, it's going to be like a little thing. They're like leveling up your character, right? In a video game, you're going to unlock certain stats and skills as you grow. Here's the next thing we're making. Let me just scrape out my notes here so y'all don't see the logic of this. Choose your own adventure. Dude, that reminds you of that, right? So you could thank Nicole for that one, man. Nicole is like learning trading herself right now as I'm teaching her, but she's also learning Rocket Scooter, and she's been a big force for change. Have you guys noticed things have changed in the last 3 to 6 months as far as like making it simpler, shorter videos, more linearity? Like, this is the path you take. She's like, I'm a new trader and I'm confused. Where do I get started? Wait, man, it's a lot of information. Let's lower the learning curve kind of thing. So she's literally sitting here with pen and paper every day, helping me figure out ways to, from a non-trader perspective, like, it's your first day here, how can it be as easy as possible? There you go. So the next thing is the risk management module, which we're going to do. This is coming out very soon, but of course we can't have all the rules programmed yet until we get the proper data for them. Like, we have to get futures data for some of them. So, but the rules we do have, HP break we do have, UVXY rule we do have, greater than 14 o'clock rule we obviously do have. Any custom rules we do have, so gap fills will be in there. So custom rules would be like your price targets that make a market random. So my custom rules can be, I decide that market's random if we hit a half gap, or sorry, hit a gap fill, red line, yellow line. I can create whatever I want for the custom random rules. We can have some of them already pre-programmed in there too. The ones that are waiting for futures data, futures data, futures data. Stock catalyst is easy. We talked about a stock catalyst is when the market anchors and moves more than the expected volatility. This was yesterday's lesson. That's an easy rule. So Rocket Scooter is creating a brand new thing that trading platforms do not have. It's called rules with capital R. Will come predefined to preset of rules, but you can create your own. So say that Matt has a trading strategy. Matt has a rule set. You guys will learn Matt's rule set. It contains 5 rules that I call something irrational. The platform will determine that irrational means don't trade and sit out. So I'm telling the platform 3 categories. There's irrational, there's random, there's usual or unusual. So rational, irrational, I'll tell the platform I don't want to trade, period. Random, non-random, I'm telling the platform that market direction is random at this point. Some indicators no longer will work, and I can define which ones that is. Usual or unusual are things that I decide that tell me bet high or bet small. So essentially the platform is going to ask you for your categories if you create them from scratch, or load rule set. Well, I want to load Matt's rule set. Okay, it's going to come with 5 irrational rules, 3 random rules, 5 unusual, usual position size rules. And then the platform will have something called rule assist, You create your rules and it will do what you told it to do based on the rules you told it. If I said irrational means no trading, then any of my irrational rules will turn off indications and they will no longer show up on my charts live when those rules are triggered. They'll be grayed out and say, you told me not to use them and your rule is triggered. And that little light is turned on, so no. If my brokerage and futures account is tied to this, which it will be, if unusual is triggered, and I said I will risk 10% of my account when it's usual, 5% if it's usual, or unusual, whatever. And then if unusual flags, the platform will say, hey, you set a rule that said you need to be in 5% and you're in 10. Trim your position. The platform is going to tell me the rules I tell it to remind me live of all that stuff I need to keep up with. Y'all like that? So if you're going to make yours own from scratch, if you're going to come here, you can learn my rule set, mine, or you can make your own. Whatever rules you decide to use as a trader, you'll be able to program it. So one set of rules will turn your indications off if they break. Another set of rules will be monitoring your account and let you know that you've exceeded your position limit that you told it you wouldn't do. And the other set of rules, random, non-random, will have different effects based on what you say. If I say in a random market, I can decide what I want to do. I want to sit out. Random is flex. Or in a random market like yesterday, let me take a small position. It'll say, what would you like to do in random markets? Okay, well, if it's a liquidity pocket, I'll take a small position. If it's past 14 o'clock, I don't want to trade. If we fill a gap, I'm closing out a long or closing out a short. And those random rules will now alert you in an alerts window that says, you're in a position you said you'd be out. Warning. Would you like to close? Click. So you design your rules and it's connected to your account and it's telling you when you're breaking them. So how can you coach yourself if you're not consistent? You will now have something called Rule Assist, which you will force your own consistency. How do y'all like that? And imagine the marketplace internal to Rocket Scooter where John Gauss makes a rule set. He comes up with a strategy. And he's like, dude, I got this crazy strat. Resilience is less than 0. And this is there and this is there. My rule is I short every time. And he says, here's the back test. Ran the back test that works all the time. And everybody in Rocket Scooter's like, dude, I want that rule. And John's like, here you go. Let me share my rules with you. Load rule set. Matt Cowart, John Gauss, whatever. Hey, what if I come up with a rule that says, hey, look at this. If DD is greater than 1/2, I'll trade to the upper band under these conditions, right? Instead of having to create a whole new ticket to create a thing and whatever, I could just create rules on the fly and test rules on the fly and backtest them on the fly. And if we like it, we don't have to go build it into the platform through developers. I can build it into the platform and just do export and then drop the file in the Discord and you guys can import it. You now can share your rules with each other for risk management. So it's not advice to buy or sell because you programmed your rules to tell the platform to do certain things. This is tell me don't use liquidity map. And so it'll toggle off, like irrational will say don't use liquidity map. So all of a sudden, all of the things disappear from your chart. And the words will say irrational don't use because you told it to tell you to do that. So the toggle displays that this is a precursor to that. And we have they're testing out the 2 new rule sets, which would be a rule set that's being worked on now. And the rule sets are going to be programmable, very simple. If prices between A and B or volumes between A and B will be the first rules, then do something. So you'll be able to test. So a scanner will be like add, load rule. Like these are all rules that I created. And I'm like, instead of me making an endless list of scanner settings with a ticket, Rocket Scooter will have pre-programmed rules. And these are the rules. If the current price is greater than MHP, then do something. The scanner do something will list the stock in the list and give you the parameters. The alert do something will will alert you. It'll Discord you, text you, or stream the text if that happens. The platform rule assist will say if this triggers, turn on or turn off something. So clearly if we breakthrough hedge pressure is considered irrational, my rule would be on MHP breakup, turn off zones, DD, resilience, hedge pressures. Market's irrational. So going into rule assist, the risk management will have, when I load my rule set, my risk management will be right there on the side. And if any of my rules triggers, a red light will turn on. If all my rules are great, then they're all green. And next thing is if somebody gave me a rule set and they go, this is the rule set Matt uses, and you're wanting to learn it on the fly, there will be a little question mark at the top of the platform. You'll be able to click, which will draw question marks on everything that's interactable. It'll have little question marks here, 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 here. When you turn on that feature, and you'll be able to mouse over this question mark, and it will now load something up that gives you a connection back to that original pathway that is your learning tree. That'll say, there's a video on this, but before you learn it, you got to watch this video before and pass a quiz and unlock the video. You want to learn what that rule is all about? Boom, 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 there it is. So the platform will circle you back to your educational path and get you back to the place you want to learn. It says, oh, what is hedge pressure break? Well, what is hedge pressure? By the way, it's in the liquidity map. Here it is. Download it and save it. By the way, there's a video on it. Click here to watch. Goes to your tree. The video will say, well, before you watch hedge pressure, you need to understand this and this before. So make sure you watch this, this, and this to get to that education. So the platform now will have education on the rules to get you back to the rules you want, and how, or get you back to the learning the rules while you're doing it. So if you guys like that, that's what's coming up now. So as soon as we get futures data, which is the monthly maps are being worked on now, the API switch working now, futures data is going to be worked on concurrently with these design changes. By the end of February, I'm going to tell you guys what's going on. By the end of February, all of this stuff should be done. Futures data might extend into March. By the end of March, you'll be trading futures in Rocket Scooter through a variety of brokers. By the end of March, we'll have DD in Rocket Scooter. We'll have VIX risk interval move in Rocket Scooter. It might take me some time to program the index catalyst, so I'll give that till April, which is the final irrational rule. All the random rules will be programmed in the Rocket Scooter with the exception of yellow line and red line. Yellow line, red line, catalyst has to be done at the same time. So again, March on those. Your learning tree by the end of February. Risk management module by the end of February. Custom programmable scanner by the scanner settings or rules, what we call the rules effort, by the end of February. Rocket Scooter will be merging, absorbing another community by this Sunday. So make some room, ladies and gentlemen, for a massive influx of people in the Discord. Feel free this weekend, if you're available and you want to be a good sport to all the new folks. You're about to meet a lot of people. So hang tight. We'll tell you more about that. And you will have a whole new Discord layout by the end of next week, which will have all other kinds of education to go with it. So imagine that education plus our education are two different rule sets, if you may. That person has rules, I have rules. You can learn their rules, you can learn our rules, you can learn both rules. You can load both rules up and switch between the two of them depending on what you're trading. You can learn two different education trees. You want to learn this style, you want to learn that style. The experience here is going to be unlike any other experience in any other trading community or platform ever. Every time we work with somebody, they'll be able to create their own educational rule tree. Every time we work with somebody, they'll be able to create their own effort in our Discord and their own rule set you can download. Members, lifetime members, will be able to freely share their rule sets in the lifetime community or wherever they choose. Any member can share any rule set with anybody. I guess. So neat as that is, I'm just very excited to see so much stuff change so fast. Peloton filled its gap today. Taking a look at that. Liking that. That was our kind of our play from last week. I remember I made that post. Somebody mentioned that. I normally only do my challenge, my trading day. I usually am done within the hour. Right now I'm just chilling until FOMC. So how long are you trading for? You mean like time wise, or how long is the challenge gonna last? So I'm gonna trade every day, like going forward, just be for different means or different reasons. My next challenge is gonna be you guys pick the stock for me. That'll be fun. Peloton way up, right? I know I was like, I don't believe in the stock, but that was the call on Peloton. Somebody quoted us on that. That was a play from last week from the breakout scanner. And it was like 13.5, and it was like today, crazy. Had a great time today with everybody. Oh wait, somebody put up there was a poll that somebody did. It was betting on, let me log into Twitter real quick. Where's that poll? I just saw a poll. Oh. So pre-prepping for Fed, we're gonna do some long ups, like right on hedge pressures. Let's just do that. Actually, no, let's do something even better. All right. Let's do all the bull stocks. Yeah, let's just get all of them together. We'll put them right at distance of hedge pressure at the bottom, and we'll try to look for some plays on the scanner by things that pop up after the FOMC meeting. Remember, at the meeting, you do nothing. 15 minutes in, you do nothing, and then at 30 minutes when the press conference starts is when you start to see the really big movement. I would like to believe that 25 is the vote. I don't think that that's what we're going to see. So I think we're going to jolt around and kind of stay the same. We do have major earnings coming up, so let's just kind of see what's going on with some of the bigger stocks. Microsoft, sorry, Meta. Meta pressing a little hard, but again, doesn't really mean much. Apple's kind of trading down. Google, these are big ones coming in. Lilly. Let's check this one too. See what's going on with some of these. Okay. So monitoring the different places, we're going to put 2 rocket scooter instances side by side. I'm going to multi-chart this today. We're going to watch 2 things. Actually, 3 things. Actually, no. You know what? Let's watch all 4 things. I have some real estate here. Let's get that VIX on there too. Okay. We're going to prep all 3 of these, right? Make sure we have our levels correct. And we're also going to watch VIX. Just double check. We are breaking hedge pressure on VIX, which does make the market slightly irrational right now. So be very, very, very careful today of anything you guys do. This is also VIX call wall, so we have 2 irrational signals today. Be very careful, those of you. Okay, we're rational in 2 fronts. UVXY with the UVXY call zone boundary break and a hedge pressure break. This is very important. We usually UVXY to measure our some hedge pressure activity in VIX itself. These are 2 major cautions right here on this boundary, everybody. Is there some difference in my USA and EU in the platform? Marius, no. We only have US data at this time. US stocks, US equity, US equities, US options, and we're about to have US futures. As we grow and get
get like larger user base, right? If you'd like to try that out and help us grow. Our next step after we get all the US stuff, we'll clearly be trying to get some products from around the world as well. Europe and Asia mainly. Stock markets and options markets from out there if it's available. What's the smartest time to enter to avoid IV crush? You talking about into Fed after the event or week before the event? Like anytime leading up to the event is a terrible time to enter. Yeah, like traders that are trading options. Again, this is not investment advice for what you to do, but the smartest thing a trader, in my opinion, is to get out of an options trade the moment before the FOMC. If you're winning, your IV will be the highest at the event nexus, right? And the moment after is when it crushes. After the move takes place and you don't break that expected volatility, your crush happens momentarily after. So low IV on FOMC would have been earlier in the week. IV is building, ramping up, very much ramping up in this last half hour. And then slightly after the event, it's crushed. So the lowest IV would be like in an hour or two or tomorrow safely with avoiding the volatility of the market in general, or like days before the event. John's given some more knowledge bombs. These guys are smarter at options than I am. Estimated about 60-ish. To sell an organ today to buy an SPX option. Oh, that's hilarious. So keep the two rational signals in front of our face. UVXY is kind of dangerous. I don't care to see volume there. I really don't care to see volume here. I'm just cleaning up the chart a little bit. Volume spike and SPY is pretty good. Let's close this. Ooh, I love Rocket Scooter multi-charting. I love it. Here we go. I also found something I want to show to my team. I think I want to do this.
All right, just designed another sprint for you guys. That's what I've been typing for the last 20 minutes. What we're doing. What up, Torch? What's up? What's up? Okay, so welcome, dude. Good to see you. So the next sprint I just designed is gonna be pretty cool. It's customizable top bar. I'm just sitting here building the platform while we're chilling. So customizable top bar. I notice as you scrunch things together, right? Top bar tends to like close like this. You can dismiss all. So the idea is I want to be able to customize the top bar. So I want to show whatever I want to show. I may not care to see DD on all the things or MHP on all the things. I may just want a specific chart to show a certain thing based on what I'm trading. If I want to program a rule, like in certain, if UVXY has a couple rules, I might want to just show those 2 rules here. If SPY has 5 rules, I'm going to show those 5 rules there. I can program however I want, which would be the cool thing. And then you can have an option that says, you know, click a button, everything cleans up. You just want a clean chart. Or click a button that says, or like an option that says per ticker, or an option says maintain on all. So it can create like a standard that opens up on all instances, or per ticker. It'll remember that I had a certain setting for Qs and a certain setting for UVXY and a certain setting for SPY. Yeah, Piton earnings today, man. For show. What's up, everybody? Welcome to the stream, man. We're getting like huge numbers day after day after day. Y'all have stuck with me all morning. I don't normally stream this long. I love saying something provocative. My aggressive rate hike schedule to 0 by next month or the month after. People are like, LOL. And I'm like, okay. The best part about seeing something nobody sees is nobody sees it. So because nobody sees it, it's going to always sound a little silly, right? Okay, let's find a new playlist. I'm going to try something different. I'm trying to listen to that same playlist and repeat for like the last 4 times. Let's do no copyright lo-fi. Let's go. I do like Lo-Fi Geek. Let's go there. Lo-Fi Geek is dope. One of my favorites. All right, so the trick to trading the FOMC is you don't. The meeting will come out wash. It's very predictable what's going to happen. It's going to be 25 basis points, a high probability of that. There's no surprise that I can... I need to not have Windows do that. You turn off these Windows arrow stuff. And so the market's likely going to respond in a very predictable fashion. Positionally, we're bullish, right? Bull support here. Stocks themselves, earnings-wise, a lot of market caps trading down. So we're kind of sandwiched in the middle. I think the FOMC is going to stay in the appropriate range and not particularly do anything scary. Current NQ, low DD band, 291.22. So to make sure that we maintain this trajectory here, DD greater than 89 tells me the market wants to be near the upper band, below the lower band. So that's a pretty decent sign. The market is clearly in rational territory again. So we're pretty good there. So I'm going to monitor volatility. We need to double check just really quick on UVX. I mean, on make a quickie little nod of triple B, which will be way up here. I would say I'm gonna just kind of estimate 2 or 3 days ago where we were trading. It's about, let's just say about here. 511 and some change. Let's just mark it. I'm gonna get all of my things that I need to mark, and we'll just put it right here, right? Pretty cool tricks. I'm glad you guys are tuning in. Welcome to the stream. Some people just kind of joining up. We love y'all. I'm on day 5 of my trading streak. 10K to 100K. Again, we build it proportional to the account. Haven't had a losing trade yet in 5 days. It's great. Not even a single losing contract. Not only dumping the contract, every contract has made money. It's weird to see side by side, the losses literally say 0 and all the fields are blank. Lucky me, I guess, but hey, maybe I'm doing something. Triple B is here, so we know that the market gets a little crazy when we pass through that. We know that anytime we do go through that, market will be irrational on 2 fronts. There's a rule on call zone UVXY. There's a rule on hedge pressure break UVXY. Up inside of here, market's irrational, no trade for me, or small position that happens. Right now, QQQ rallying. Against negative resilience in the zone here. One may understand that a catalyst has no rhyme or reason. We must draw our boxes for catalysts. Let's give it a color. What color do we want? Green. I love green for catalyst. Let's make it a 29.5. So 5.9 points. For 11.91. I'm sorry, 2.9. 2.95. I'm stupid. Okay. 48.96. If we break through this band, So our catalyst range will be this box here on SPY. We're gonna make sure we have one on NQ. Is it still 109? I think it's 109. So these are important numbers, right, on the event. This is tricks of trading. Y'all learned something here. You have some fun there. Could somebody tell me what the QQQ equivalent is for 109 risk interval, please? I'm gonna be lazy and not calculate it. Can someone do it for me? We traded poo today. Oh, I love it. I'll just estimate it'd be like half the bands here. $296.5, 202. Someone just to say it's gonna be 5.3 divided by 2. 2.65. Okay. 4.67. All right, let's do it like this. Okay, so when the event happens, this is a movable box, right? 2.64. Oh, Garrett, I love you, man. Thank you, thank you. Was I close? 2.64. Oh, nice. I just estimated it from just my bands calculation. Cool, cool. All right, so I did 2.64. So what I knew is when the event happens, right, we're going to draw an impact red line, right? And we're going to measure if the event moves this distance or higher from the moment of the event, it's irrational again outside of that range. So keeping in mind window of opportunity. We'll just draw it and show you guys how this works. So we're going to be... Oh, I love this transparency. That's pretty. Okay. Let's say like, let's do like a no-go kind of thing, right? Irrational there. And also, right, you're in the random territory anyways because FOMC happens at 14 o'clock. You guys loving Rocket Scooter? Feel free to hit that like button while you're here. We love having you folks join us. I'm just painting pretty pictures while we wait. What's up, man? It's the longest stream that we've done with Rocket Scooter. I usually don't stick around this long, but I'm having a good time today. Okay. So irrational, right? We don't trade when it's irrational. And again, markets can be random anyway, so I don't trade after that as well. Let's see if I can maintain the streak. We'll know. This right here will be a movable thing that we can do. And again, with S&P, it's gonna be the same thing. Draw like a little bit of a... I like to do it like this. This is the window of opportunity. This is a new thing that we train on. So don't trade when it's purple. All right, guys, what's up? What's up? Yeah, just the rectangle tool. So I'm basically drawing, right? These are my catalysts. Let's prepare with like a horizontal ray. Let's go ahead and just get ready for like the catalyst itself, or the event itself. Green line, I like to do these. 1 point, and we'll go ahead and we'll do like a text, right? We'll say FOMC. I just like marking. It's always good for them to mark up your charts. Now, granted, I don't usually trade on FOMC, but I have some really good I have some really good range today, right? This is gonna be some good opportunities today. I might be able to get a decent second trade. I know it's dangerous and risky. I'm gonna trade something very small. Keep in mind that if we lose these key levels, we're irrational on VIX. So again, window of opportunity when automated on the chart, we'll actually have it just like this. Rectangle tool. Yeah, I love this rectangle tool. It's dope. All right, here we're gonna have irrational market here, right? It's hard to think that we're going to rally leading into major earnings. That Apple, Google, Meta's today, Apple, Google tomorrow. So, but there is a bull support that I'd like to hit just to scalp in the middle of the range. So my idea, I did my trade idea this morning. Now again, when trading FOMC, the trick is not to do anything in the first response. The first response is typically a wash, right? There's 3 periods of movement in the FOMC, and I'm going to tell you what they are. And they're very predictable because it's happened every time. I've been doing this for years. So first one is you're going to have like 0 to 5 minutes, right? You're gonna have an event, and right when the event happens, that's the point that you need to pay attention to. It's the anchor point. You're gonna move up, move down, whatever. But the minute you pass right back through the anchor point from either direction, then that statement was priced in before it came out, which means all the people that guessed it right. The next phase is 5 to 30. The next 25 minutes tend to be a little different in that you tend to get a directional move one way or the other as people are forecasting what the ultimate thing is at minute 30 is a press conference, which is the real move of the Fed. Hold on to your hats. Not only are you past the 14 o'clock window where we say markets are random anyways, you're 30 minutes in, and an hour and a half till close, it's double random with the potential catalyst. The second move comes when Powell starts talking further about further rate hikes. Now, we did some math this morning, and as a community, we believe, well, I believe, sorry. Okay. That the market, today's thesis was pretty solid. We did amazing work this morning looking at the numbers that are going into inflation and the mechanism of why we raise rates, right? So Powell is in a place where he's achieved his first goal, 5 to 10% of layoffs in a lot of the markets. And so certain sectors are coming down and certain sectors are going up. We're getting shortage again, so consumer staples are going up. Energy companies are going up. Other companies are coming down, tech and finances, etc. So half the stuff's going up, half the stuff's going down. The SPY is basically flat. We still got major earnings coming through. And so some companies have been very resilient to rate hikes. As a matter of fact, energy companies are like trying to bribe people to stay there, offering massive salary still because the energy is still trading high. So right now, inflation's bottoming out. It could likely go up again as we start to see shortages start to build and build a second wave of inflation. It's not going to be as bad as the first one, but a smaller second wave in spot sectors. So the FOMC needs to step back a little bit and see if company performance. All they did was raise rates to induce some layoffs, which controlled wages. That was the whole strategy, and it worked. Now it's kind of like we looked at the data today, and there's a lot of available jobs in the JOLTS, and there's a lot of available workers. And the continuing unemployment claims that aren't getting jobs. Why? Well, it's because the jobs that are open are specific skilled labor that the jobs of people laid off aren't. So some sectors have people that got laid off that can't get another job, like for what they do for a living. The jobs that are needed, they can't find the worker for that thing because it's high demand for that thing. So some things are high demand, some things are low demand. And so half the stuff looks good, half the stuff looks bad. So the Fed has to go through and nuke the stuff that's doing good a second time to squash inflation there, but they can't do it now, risking losing half the market by crashing the stock market. So the Fed is going to taper. It's very easy to see that. We predicted that last July that the Fed would taper by December, and we were 100% right. And in November, we said it would be 50, and it was right. And in December, we said in January it'd be 25, and we're likely right. And I'm saying by February, or no later than March, it'll be 0, and we're probably right. The green rectangle is the risk interval range, something that Rocket Scooter teaches. If I blast beyond this risk interval range, the market's going to be considered irrational and very illiquid and one-directional. So imagine that right now, the FOMC event happens and we skyrocket from there. I'm going to measure a distance of this one way or the other. We get those numbers from our risk interval bot, which is an exploit and futures. And so if something moves so far, so fast, we call it a catalyst. We actually have a measurement for a catalyst. You may say, is that a catalyst today that moved the market? We have a technique that tells you that. This distance for any futures contract is an exploit that says the futures market can't handle the move. And so there is a specific distance for S&P and a specific one for NASDAQ. If either one of them moves too far or too fast, I'm not going to exit a trade. But imagine that it moves and stays in that expected, it's the expected volatility of the index on an event. So this is an exact 109 points for NASDAQ futures, 29.5 points for the S&P. And that bot calculates that number. Destiny. So I'm just pre-marking my chart up with what I expect to see. I'm not going to trade here. I'm not going to trade here. And after the event happens, I'm not going to trade at a distance beyond if it goes up, or a distance below if it goes down. And if it goes down, again, it's already in that purple. I'm not going to trade anything. It's a cool technique that we use to understand that the market has kind of overstretched its boundaries. The event hit too hard, right? Like a meteorite's falling out of the sky and it just burns up and bounces on the ground. Nothing happens. Okay, we just ignore it. It's gone. But if it lands and lands into a lake and you know, blows up a square mile of land, and obviously you're going to have some response in the ecosystem to something bigger. Same thing, like markets only like to move so far until you get additional weird order flow. So I promise you this, if you stick around, you're going to see some things you've never seen before. Stuff video Rocket Scooter is pretty cool. And when you see if the event moves the market past this distance, you will start to see unusual volume spikes. I'm talking unusual, very, 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 very large volume spikes, because you're creating margin calls in the market making world in futures that will mirror in hedging in the index. You'll see QQQ and SPY start just ridiculously high volume. Okay, ready? Everybody here, make sure if you want to play along with the software, it's actually free. Now, even a credit card required to check it out. If you haven't seen it, Rocket Scooter is a trading platform. I am the CEO of the company. We're a very large company. We have built this over the last 3 years. We've created a brand new type of analysis that shows market maker positions and large institutional positions. And we do all of our understanding with that. We don't use technical indicators here anymore. I'm currently doing a 10K to 100K challenge. I'm using futures this time. As soon as I get to 100K, I'm switching to another challenge where I'm going to let you guys pick the option for me. It's going to be options trading. So the challenge is we're going to wake up every morning and I'll let you guys name your favorite ticker. I'll have a bot read everything you type. and the bot will randomly pick a ticker from one of y'all, and I'll trade that thing that day. I'll let you pick what I trade every day. And I'll trade options in that thing every day. And I'll do a 10K to 100K challenge, letting y'all pick the stuff that I trade, just to show trading skills randomly and random stuff. Currently, I'm trading index futures just to draw this. I've been to draw this account to 100K. I started with 10K like 5 days ago. This is day 5. We're now up to 11.2. So 11.2% gain, 100% win rate. Haven't lost a single trade yet, a single contract yet either. Every in and out has made money. So I actually have lost 0 trades in 5 days. 0. It's a 5-day streak. My results are atypical. I've been trading for 13 years. I like to come on YouTube and trade these live challenges. So everybody, if you don't mind, like the stream if you can, and click that subscription button. Subscribe to us. We're live every morning, fully transparent, which you'll see that no one else does. As far as live trading goes, I'll show the broker statement of the history of the challenge, all the stats. The account liquidity will stay on the screen at all times, so there's no hiding losses. The account number will be on the screen, so you know that it's real and not fake. Every position I'm in will be on the screen at all times, and every order I ever do will be on the screen at all times. So you want to watch a real trader, there are literally 0 of them that will be transparent on a daily basis at the same time every day. And if you want to watch us, then feel free to judge for yourself. Watch the results if you want. And we love to have y'all here. So it's free. Check it out. And we're ready to go. I've got all my prep work here. Everyone rocket scooter. Let's get some hype going. Where's my rocket scooter peep set? Y'all ready? Get FOMC in 2 minutes. Let's get some rockets to chat. Let's go. Let's go. Let's go. Okay. I'm going to estimate, because resilience is negative, that we are going to resist half gap and sell unless the index pulls as positive. This number and this number tell me that we are going to be below, likely, at least for now, these zones here. And the opposite is that this DD number is saying that the bull zone is likely to support. So we have resistance signal and support signal. Wide choppy range is likely happening. Here we go. Make sure you get your financial G's front and center. Let's make sure we're reading what's going on. Market's already starting to move. I don't do anything at the start of the market. Okay. Nothing at the start of the announcement. Nothing. Twitter, the fastest source of news. Let's see what we got. People are starting to pre-position already. Possible leak, but again, we're probably not going to do anything surprising. You hear some sirens go off in just a moment. Expectation, I believe, is 25 basis points. I'd be surprised if it was 50. The market will love hearing 0, which don't know if that's going to happen. Here we go. Let's go. Oh. Ooh, all right. Okay. I don't even know if I want to do anything. There's that bottom hedge pressure. Let's see. The move is very tight, very concise. I'm not going to touch it. I'm not going to touch it. I'm not going to touch it. We're going to let it move. What do we got? I want to see that hedge pressure bounce, though. Let me go to Twitter and see what we got. $25, that's it. Yep, 25, that's it. Expectation is good. So what we're going to do is we're going to mark our catalyst area, or mark what we call an anchor point. So rocket scooter techniques. So again, I do definitely want to take along a hedge pressure, but let's let it touch it first. Resilience is still negative. This is not going to rally.
in my opinion. And we've already cleared that same spot that... Ooh, should I scalp one more time on resilience? I don't like to trade post-Fed, though. Okay, let's just short one micro. Resilience back. No, you know what? I'm going to keep hands off. I don't like it. I want us to trade lower, and at the press conference, I'm going to get a long at the bottom to the base. So that's what I kind of want to do. So what I'm going to do first is mark where the event area is, and this is the first thing you should always do if you're learning this. Oops. Let's go ahead and take this green line. I'm just going to mark it. As you see, we traded down and back up so that it's priced in effectively, right? There's no surprise. As we tell you, if you return to where you started, there is no surprise. So the market is basically where it started. I don't want to do anything yet. The statement is here. There is no catalyst. Okay, so we're great. So if I were to mark the distance up or down using this tool, like we said, it now changes this purple box to be even smaller. Do y'all see that? So now we've lowered the window both directions, and the window is where I don't want to make trades. Now, my expectation is that we're not rallying off of this. And my expectation is we're not going to do much until the press conference, because what we need to see is that we're going to zero next time around. And so let me go ahead and raise this to there. So that's how this works. You'll see that? So nothing out of the ordinary. Okay, so now I have my window of opportunity set. I'm going to likely want to trade inside of this band off of this hedge pressure as long as we tap it. Now I want to get very, 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 very close to it before I do anything. I'm going to make sure I enter. And again, since I've already made a pretty decent chunk today on the account, the only thing I want to do is bet on that edge holding tight. And I'm going to put like a micro on it. Now be very careful, because we are close to those DD bands on NASDAQ. So it's going to be very tight right there in the NASDAQ hedge pressure levels. If you guys want to check out the Rocket Scooter platform, like I said, it's a free trial. You can learn all these techniques. The free trial doesn't cost anything, and no credit card either, so you can So what I want to do is get good R&R on the trade. So right now, do y'all see how I basically close in the window a little bit? So let me go ahead and now span this out, since I know exactly what I want to do. The FOMC has been priced in as he returned right to that catalyst level, right? So, I mean, the event level, which is great. I like to see that happening. Let's put these words out of the way here. I'm just basically marking like where I do and don't want to trade. So these boxes are just kind of showing me like where I do and don't want to trade. Resilience is showing me resistance at this distribution zone. DD is showing me support at the bottom. So again, we're sandwiched in the middle, which is exactly what I said I was expecting to happen, and that's happening. So again, no trade. Like I didn't want a short or long. I did want to maybe engage in a short here, but again, I'd rather engage in a long down here back to mean. I want to get a nice R&R on that and tap it there. I almost clicked the button, but not yet. That lower DD band looks like it was tapped in the S&P, which did move us irrational. So take everything you see today with like a grain of salt, right? We're gonna have to be very, 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 very close. See, we broke through that irrational band one time, so markets be a little strange. I'm keeping VIX also front and center. If we break through here, then it's not gonna be very pretty for the market. I'd love to see VIX stay in decay. Your triple B line I've also marked there, which is going to show longer term volatility. We get no love for resilience today. So the market is not finding any power. Resilience predicts what we do at half gap, which is the dashed line here. So both S&P and NASDAQ are negative and negative. So NASDAQ pushing through this zone with a negative res is not really a believable move, but I don't do anything in the first 5 minutes anyways. That volatility, once it's traded out, is likely going to sit flat and wait till the press conference. What the world wants to know is Jay Powell going to zero next time or not? What do y'all think? Everybody here, feel free to click like on that stream if y'all don't mind. I'd love to have y'all check it out. Subscribe to us. Be here every day. But rate hikes are not over. They will come back in the summer. That's my forecast. I said that. Got some retweets on that too. Ooh. All right, let's see if Rez is catching up. Ooh, should I short on half gap? This is moving. Now again, the DD band is supporting at the bottom, but nice little breakout here. Dare I with just one contract? Let's see if Rez. Okay, so remember, irrational tap does mean that resilience will lag the market. So the index is moving first. This is a battle of Rez. Let's see what the stocks do very rapidly here. Let's see if we get it. Should I? Man, I'm shorting in these BLUs. That is, remember I said that's the trade I did want to make from here to here? Futures still pricing rate cuts this year with the Fed funds saying 4.48 by the end of December. Ooh, there's that rate cut word. Again, if you hear the word rate cut, this is something you don't want to fight. Wall Street loves the idea of rate cuts. Now, zero is what I believe. Upper DD band approaching for QQQ. That's the upper expected target. That'll hit the market irrational in the first go. That was a dip I did want to buy. Hypothetically, I would have made that trade, but I didn't. I didn't do it since we dipped irrational. Scared me out of it. So I love sitting on the sidelines. Expected. Yeah, and you see, do you guys see how Rez lagged the index? Anytime you go through irrational territory, resilience lags the index. And we assumed that it could. And that was exactly what we saw that happened, right? I love that idea. The index moved before the stocks did. And that's what you normally see when people are getting squeezed out of trades, right? And we reverted back to mean. Now all that matters is earnings. The statement is pretty much, the vote in the favor of policy is unanimous. This is another news report that's coming through. If you get your financial juice front and center, it'll show you this. I am saying inflation has slowed slightly, but remains high. That's expected as wages are being fought on the ground floor. Neat thing to see, NASDAQ resilience on a percent market cap basis is the stronger of the two, going to Apple, Google, and Meta earnings today. Apple and Google are tomorrow, Meta today. It's interesting to see the NASDAQ have that effect. And I think I like the idea of putting 1 to 2 contracts on the line, and maybe I should do a NASDAQ. Although I hate the SPASDAQ. Something small. Why would I want to short? Resilience is, remember, resilience lags the market, so it's not really to be used right now. And I don't know if I want to do anything. It would be considered over trading at this point. Number one, we hit irrational territory in the purple, so the day is over for most traders. Number two is resilience typically lags or leads the index, but anytime you pass into the purple and come back, resilience doesn't lead anymore. It's a trick that we use as a trick. It's a technique. It's a very solid technique, actually. And so the index is actually moving first before resilience. It's going to be really hard to gauge the market from here. But the only pivot that is left is this upper band pivot right here. And again, the press conference will clue me in. It's only been 10 minutes in the Fed, and we've seen a lot of movement here. Should I risk anything? It's hard to say. I'd like to go higher if I didn't want to short. I don't want to short from the middle right here. Don't want to do anything yet. Kind of going to read the news and see if we've got any good information coming out. What's going to matter is the forecast going forward. Do we get zero? Do we get rate cuts? When are rate cuts coming? I think we're zero till the end of the year. I made a tweet if you guys want to check it out.
is right here. I've predicted the rates every single time on Twitter since last June. I've nailed it every time. Got it right. We got 25 points today. Got that right. VIX is in collapse. It's pretty good. I think shorting's off the table for today, but I think tapping the upper DE band and betting we're not irrational, maybe something, but NASDAQ would be where I'd go. Don't I have NASDAQ on here? No. Okay, let's add the SPAS deck on there. Unanimous policy is good. It means everybody's kind of on the same page. How much of a delay on the stream? YouTube has like a natural delay. You're probably 30 seconds delayed. Maybe a minute. Four-second delay. Okay, I'm going to start counting. Ready? Somebody say something now. Eight seconds. It looks like an 8-second delay. The charts match my Thinkorswim charts, match Rocketscrew charts. They look the same. Maybe your charts might have delayed data or might be experiencing some lag on your end. It was at YouTube. Oh, okay, yeah, you're like 8 seconds behind on YouTube. What's up, Mateen? Ooh, that res is starting to sink while the index is pushing up. I do like that idea. Let's hit that close price of yesterday. Let's fill yesterday's gap, right? Let's see if that happens. I'd be willing to take a short off of that just because, you know, I think we're going to revert to mean. I think we might actually trade a little lower. Again, it's a little unnerving to short against a bull long up where I wanted to actually buy the dip there, but betting against a choppy market, at least spanning one side to the other, is pretty decent. I'm not going to bet we go irrational, but it's only for a scalp. It's not for a reversal. Just click live in the bottom left corner. What causes the half gap to be significant? Oh, is a great training tool there. What causes a gap to begin with is the most significant thing in trading ever. Gaps are the most important thing you will ever learn in trading, because at the end of the day and beginning of the day is when the major institutions buy the majority of their positions from the market maker. The imbalance, you might hear share imbalance sometimes reported, like CNBC says it all the time. Your TD Ameritrade News will send you share imbalance in the SPY. That share imbalance is a big deal. And the half gap is the halfway point between the open and close. Market makers will gap up or down the stock in the morning based on the imbalance. And the redistribution zone, or like these white lines with the dash in the middle, is where they unload that position they have to take. So if we imbalance them with 100,000 shares, they kind of got to get rid of it by the next day, or they try to. And the zone is when they do it. The redistribution zone is a great example. Where we are now, the pivoting between here, here, and here, you're back into market maker territory, playing with those imbalances that we've been dealing with. I'm going to go ahead and take some risk. I'm going to trade inside of here as resilience is plunging. I'm going to build a very small position. Something very small. 3. And that's it. I will add 3 more here and call it a day. I am going to bet that we're going to revert to me on the low side because the stocks that are trading right now down are stocks that have earnings that go today and tomorrow. So I think we'll pull back a little bit. Resilience just kind of nuking today. We're not going to go past half gap. So this resilience number, as long as markets are rational, which they are now, but they weren't for a second, as long as you never touch these like purple bands that I marked, right? What happens is resilience is telling me that the stocks are not passing their half gaps weighted by market cap. So why would I bet that the S&P does the same? Resilience is my main pivoting tool inside of this environment. Now, it's a leading indicator. Most of the time, the stocks will follow the index, but anytime you go irrational, the index will usually move before the stocks, and now I'm shorting. And this is a great trade, another $100 again, shorting just to come back to the mean in this area. And that was pretty fun. That was pretty cool. There's the catalyst. Let's close out $100 again, in and out, predictable trade. And I haven't lost a trade yet. Let's get some rockets in chat. Boom, 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 and boom, boom, boom. I'm done for the day. Let's call it a day. Just right there. Resilient scalp right back to the catalyst start or the event start. And now we're done. Now it's a quick 1%. And let's call it a day. Now again, not impressive, right? Or maybe, I don't know. What do y'all think? We train you guys on trading. Scalping is my forte. I've been scalping for a long time. I love to trade on YouTube. So y'all are welcome to stay. Please subscribe to the channel. If you first stay here. And I'm not going to risk anything further. I just want to play those quick stretches. I know my limit, irrational market. Resilience is to be trusted, but it's likely to delay and not be a leading indicator. But boy, did it plunge very quick before it did fall, right? And that was my sign to stay on my short, and I was excited. And we fell back to the starting point. I closed it out. Let's go. Let's go. Oh, yeah. Let's get some rockets, baby. All right. Hang tight. We'll show you the performance. The small count challenge. Chris Lee says combining Roxy with your own strat has been a literal godsend. Thanks, Matt. Well, you guys inspire the development of this risk management platform. We want to really give you guys something that is substantially different. And I wouldn't commit years of my life to building something to release more of the same. And there's people that commit most of their lives to reinventing technical analysis and giving it a different color. And to me, it just doesn't really sit well with kind of like where I want to be. I want to make something different, and I'm glad you guys are enjoying it. Travis just threw up in his mouth a little bit. Getting flashbacks of those shapes and colors, huh? Some guru popping out their crayon box, chasing the market with their head in the clouds, and they're 5 steps behind. TA is not going to get you anywhere. These are all trading on specific mechanisms based on a lot of cool stuff we teach. I put all my techniques on the chart for one purpose only, in a catalyst to prepare myself. Irrational in purple. I manually drew this. Risk interval in green. I drew that. We have the event on the green line, the FOMC. We have distribution zones. The fact that we tapped rational, I don't really trust resilience as a leading indicator, but boy, oh boy, when it falls from +3 to -30, that's a really big jump of market cap, but doesn't mean I'm going to short the market for it to sell off. I just want to get a quickie scalp from half gap to where we started and closed out. I was the first one in. I was the first one out. That's what day trading is about. You need to see something that other people don't see, and it is a skill set you must practice. If you think, I think I made 70 trades at this point, I don't know, 50 to 70, somewhere in there. And the small account challenge. And I haven't lost a single contract yet. They've all been winners. And doesn't mean these results can be replicated by anyone else. They're unusual. And we have to always be, you know, ethically and morally responsible to you to let you know that trading is risky and everybody is going to have a hard time trading. And we're all kind of trading against each other in a way, right? I've been doing this for a very long time. You're going to have to pay your dues to learn trading. We teach and we train traders how to think, behave, how to act, when to trade, when not to trade, things like that. Those skills are designed to give you a repeatable behavior so that you can self-coach as years go by. You will struggle, but knowing when to trade, when not to trade is a big part of what needs to be taught in the retail side, and no one teaches something like that. When to sit out. Press conference in 8 minutes starts. This is where the big move happens. As I said, the way FOMC works is the first 5 minutes, there's a small move. And again, rewind the stream and you will see that I do exactly the same thing. 0 to 5, there's a small move that usually works its way back into where you started. Then I said 5 to 30, the next 25 minutes, there's a bigger move. And then 30 plus is your break. So there's your small move, there's your bigger move, and 30 plus, get ready for a random thing that whatever's happening right now will have nothing to do with. As you see, people are just repositioning and trying to get out of the way of what's coming. So the forecast is all that matters now. Here's your 5 minute small move. Here's your 5 to 30 minute second move. Your big move is coming. Watch out. If you break through UVXY5, the market will need a new pair of pants because it's going to shit on itself. Do not believe anything you see on the charts right now. Keep an eyeball at this UVXY5. That's it. That's going to be a big deal. Resilience is likely going to control the market today. DD is going to support the market. So if we're in any of these purple bands, the market is going to go kind of crazy. I would like to see it go nowhere. I'm looking at Fed Fund futures right now are pricing in a currently 85% chance of a 25 basis point hike in March and a 15% chance of a pause. Again, if you want to see that Twitter post that's kind of blowing up right now. Ooh, I love when that happens. Okay, let's see what people are saying. So, by my own calculations before the event, 25 January, 25 or 0 February. And if you want to check out Financial Juice, here we go. 25 in February, January we got. 25 in March with the 15%. Oops, did I mean January? I meant now, sorry. I should probably edit this because I meant to say February. I did the wrong month. When I said Jan, Feb, like today's. Here's me being hyped up on caffeine. So add 1 to each month above. Oopsie. Oopsie. Same thing though, same pattern, same pattern. So let's go back. February, we got 25. March, 25 or 0. And 25 or 0. 15% chance of a 0. I love it. We're getting it. See, you guys are understanding how This morning, we're getting a step ahead of inflation. Today, we're getting a step ahead of rate hikes. Right now, I'm getting 2 steps ahead of the trade, so I'm excited to see things move the way they're moving. Hey, what's up, Marius? Good to see you here, man. My team, man, it's clawbacks and scalps. Good, man. You guys are killing it. Now, again, this is not like a copy trades or follow trade service. We actually train people here. We've got almost 4,000 people in our Discord now, almost 1,000 users of our platform. We invite you all to come check it out. That is free for a week. And then you just pay for the service and your data. And it's actually pretty cheap after that. It's less than $100 a month. Covers everything. Let me make sure I make that correction on that. Y'all think I'm going to make the 100K, or you think I'm going to blow up to 0? Let's have a vote. Everyone in chat. 100K or 0, what do you think? How long will it take to get to 100K? Probably about 3 months, give or take, from 10K. I'm gonna I'm going to replace my old tweet. I'm glad you guys tuned in for this. 200K, 120K, 2 month. You listen to Jerome. Wait for the headlines. I don't listen to Jerome because while I love his soothing grandpa-esque voice, he can read me a bedtime story if he wants, but I'd rather just read the headlines. If you use Financial Juice, you're gonna get all the best news aggregated for you. Go here and just watch it, right? This is gonna, they algorithmically pull it out for you, and you can read what's saying. Inflation has slowed down, blah, blah, blah. So here's the press conference we're going. These are the words, right? He's gonna say right for your very eyes. Full effects of rapid tightening are yet to be felt. That's true. That will come in summer. We have more work to do, yada, yada. We continue to expect ongoing increases necessary to achieve a significantly restrictive stance. Again, while we do go towards zero now, as I say, will be zero likely next month or the month after, we will ramp up again at the end of the summer because they need to still put things like consumer staples and energy and healthcare in check. These are going out of check pretty quick, and they still need to make sure that we're not getting rapid increases in inflation based on shortages in, like, you know, food and energy, for instance, or, you know, industries that really haven't been touched by that. So let's see, last year economy, he's just talking about whatever. The red is gonna be important text. He always says the same stuff. That's why this shit's so predictable. Matini nailed it. He literally is so transparent about what they're going to do. Here's what you're going to see. He's just going to comment on this, comment on that, and that's totally fine. We're now irrational in the market. Keep an eyeball on the VIX. VIX UVXY breaking 5 is a big, nasty thing for the market. Irrational market can collapse the market for the day. So be very careful. We never hit the upward ED band. We got close to this, but catalysts rule the day. Now we have a new event, right? So we're gonna go back to where we started. It's gonna be a little, if you don't know rocket scooter stuff, it's gonna be a whole different thing, right? So now we're trading down. We need to, let me move these out of the way because there's no more catalyst anymore. Now there's no more event on the original rate hike anymore. Now we have an event on the press conference. We're gonna do the same exact thing, but in reverse, and we're going to redo these bands. It's such a simple technique that we do all day, every day. And again, that's outside of that known territory, which is fine. We're going to redo our label, right? And that was that call for short. FOMC statement, meh. Let's do FOMC press conference, right? That's the actual catalyst. Did you guys all learn how to trade the Fed today? The small move, the middle move, the big move. Didn't we nail that too? This is exactly, and again, it's not rocket science. How do I know that you have a tiny move, a medium move, and then now a big directional move? Well, I've 13 years times 12, right? What was that? 146 or 156? 156. That's how many Fed statements I've seen. I've seen a lot of them. I'm used to it. You do it enough times, it's going to be very similar. And environments will change, you know, and it's not easy when you get, even the first year, you're in a bear market. If this is your first year, it's not going to be the most, the easiest market to trade. When you've seen enough of it, though, you've seen enough of it. This is my second recession, by the way. If you include COVID, I guess that'd be my third market, quote unquote, crash or whatever. But it's like, once you do it long enough, you know what to, you know, you've seen it once, you've probably seen it a million times, but it happens that way every time. We're the people that find like cool patterns for you. Fed FOMC press conference is the actual catalyst. If you start pressing outside of the band on the press conference, that's a bigger deal, right? So constantly, and Rocket Scooter is actually, when you got our futures data in a little bit, it's going to start doing all this stuff automatically, like drawing where things do and don't work. And I'm just making them like colorful in my own reasoning. Oops. This is like a little, I think this is a little messy, to be honest, looking. That DD is holding with that ratio being high, that bull zone is going to want to fight and hold. But boy, oh boy, it's looking a little bad. Without hard, what Analytics says, without hard stops, 20% of 100K, 80% to zero. Yeah, pretty much. He knows. He was here probably last couple of challenges they did. And it's great when I get viewers of all types coach me, and it's neat to see that like I'm not impervious to learning or like messing up or being human. I mean, shit, like in 2020, I had some really bad performance. I even got COVID and was still trading while I had COVID, right? And you had mush brain, and that really was a thing. If you ever got the first round of COVID, that brain fog is a real deal. And I was just doing stupid stuff because I didn't know I had brain fog. You didn't know. I actually had COVID 3 times, and the last 2 COVIDs were pretty weak and not so bad. The first COVID I had was awful. So I was out for 6 weeks. I was sick with first COVID. And that story is just like basically saying that my own members and viewers are actually coming in, coaching me on the stuff I was doing right and doing wrong. And so, you know, a new risk management stop loss philosophy overhaul that led to the creation of Rocket Scooter rules came out of some of my own trading performance. And so it's good to see like people... That DD is loving the hold. That's a trade I wanted to make earlier today. So now, press conference making another go up. Let's see what this, right? Orders inflation, below trend growth, and some late. I'm just done marking this up. Press conference is going to have a different place to create a catalyst. You see how crazy it gets after press conference? They're making decisions meeting by meeting because they're watching the labor market and the unemployment numbers. I'm just going to go ahead and like, I'm going to mark all this up later because it's just flip-flopping a lot. Let's just clean all this up. Now there's a catalyst to the upside. So let's just kind of clean it all up. The, you know, purples don't trade. Let's get here. Same thing. See what I mean? Don't trade this. Don't trade the FOMC. It's so stupid. Trust me when I say there's only like 2 live streaming futures traders that show their trades every day live. It's like Trader Matt and myself are the only people live trading at the time on YouTube. And you'll see if you follow, if you especially watch him, Matt's a great guy. I love him. And also when people here are trading futures, right? Index is like your specialty if you trade futures. So FOMC is an index thing. And there's a reason why you don't see a lot of people trading live, because trading is hard and a lot of people don't want you to see that. They haven't got a grasp of it yet. So be careful going out there trying to gamble at the wrong times. I'm going to tell you, I said this is a gamble. Small move, medium move, and then big move. And the big move was a quick reversal that is irrational. And look at this, NASDAQ breaking DD band to the upside. That is this rule that we said this morning we'd look for. And again, that's it. John took a long for 350. Bro, you're taking me out to dinner tonight. That's incredible. I don't have the balls to risk it. The small account challenge is to demonstrate risk management. Like clearly, I would have loved to have longed from there to there, as that was the point. I took that medium short, got out. That was all pretty much the battling of all the signals. Resilience was negative. DD was positive. So you have resistance there, support there. And as a matter of fact, I love doing this. We're gonna get rid of this. Again, markets now blasting irrational territory. That's probably going to be all you really want to see today. So let me show you something pretty cool. And I'm not going yet, but hang tight. Don't go anywhere. What an awesome stream, man. We had people from all over. If you like what you saw, please, please, please. Subscribe to the stream. You wanna know why? This was like 5 minutes after open. Resilience less than 0. DD greater than half. And this is exactly what you see. Well, this is on SPY. Same thing. Resistance greater than 0, DD greater than half. I was saying this morning I'd want to long from here to here. I think at some point I had it drawn on there. I was going to do that. A couple minutes after open, and I'm sitting here saying this is what I want the Fed to see. Now, again, it's not like a crystal ball or anything magical. This is just math. There's nothing
out of the ordinary here, and everything that you see was practically textbook. And I think I actually drew somewhere actually I tweeted it. And we did a whole lesson on fundamentals, and it was pretty awesome and boring at the same time. Fundamentals are always boring. Hear other people say stuff, fundamentals put me to sleep. But if you do math fundamentals, it's a little different. Oh yeah, I did. Oh, there it is. It is on Twitter. What am I talking about? Ladies and gentlemen. Ladies and gentlemen, the jury. There's that 292.5 hedge pressure. I was going to long there and long there and long back to middle, which is that trade from here to here. Well, I did predict it. I didn't take it, but hey, hey. Huzzah. Let's read what big old pal is saying. Then to 1 million's easy. Oh yeah. Long-term inflation expectations remain stable, which is good. We said that as well. Will return significantly more evidence to be confident inflation is on a downward trend. Yeah, we do. We need to go through and see that the other half of the stock market is also stabilizing. We're getting a really nasty stock market where half the things are really, really, really bad inflating in local areas. Energy, food, like food staples, things like that. And then, of course, the rest of the market is like, you know, laying off people and having wage reductions. So Powell is hinting about what we talked about this morning, which was the energy and the consumer staples and healthcare. There are things that are just not getting layoffs, and people aren't like, right? There are certain industries that are making tons of money and don't care because of the shortages still. So you need to watch that to see that inflation in general is going down, right? You have to see all of that. I smell something delicious. Did you think? Oh, ooh, thank you. Man, something smelled tasty. My girl brought me a bagel, some strawberry stuff on it. Don't buck with a scooter, baby. I love it, Sean. You're the best.
Okay, let's go back. It is important that financial conditions continue to reflect the policy restraints we've imposed. Blah, blah, blah. Our focus is on long-term changes to broader financial conditions. That's exactly right. You got two things happening. They have to be careful raising rates too fast until the full effects of QT are happening, because they don't want to crash the stock market, and we don't know what the full effect of QT will do to the economy. They can't push too hard right now, which is exactly why we're rallying. Because we'll have zero next month, like I predicted. Bada bing, bada boom. Once you start going into summer where QT is happening, that's why I tweeted 0, 0, 0, 0. They're not going to raise rates and double the pain on QT. Yellow line approaching 12,400 on QQQ. There is your resistance. Breaking out of weekly highs. I love it, love it, love it. Don't fight this today. Lori, out for the day. Did you kill it, girl? Love you, Lori. So I got my mouth full of a bagel. Oh! What? Who talked about the jolts for an entire hour this morning? Who? He literally tells you what they're watching. Ooh, gosh, man. We're on fire, guys. You guys remember in Discord today? Y'all remember? Y'all remember? Y'all made fun. You guys are hilarious. So this was my hour-long conversation about the jolts, the jolts, the jolts, the jolts. And then the funny thing was we got the Pepe Sylvia meme. So everybody was like oh my god, I love y'all. That's hilarious. Hold on, wait. I gotta do like the Bradley Cooper meme. Hold on. Where's the one with the from? There we go. Mitch. Oh yeah. Killing it, brother. So anyways, talked about the jolts for a whole hour this morning. A lot matters, ladies and gentlemen. The volatility in the jolts is why you dickheads are making fun of me, because I'm so like crazy mode right now. We talked about the volatility in the jolts, didn't we, for like an hour? And those of you, bless your hearts, that decided to stick around for that. I don't know why you did. I was putting myself to sleep, let's be honest. Right? Trust me, I was making myself sleepy. As you're trading, the goal of trading is to get ahead of what the market's doing. Right, let's do something really fun. Watch. Love it. I know it's funny, but let's do this, right? What really is important to see is like what you have to do when you're trading is you have to understand why things happen. As an engineer, my job was to figure out why things happen, and that's really the takeaway. It's not hard to be an engineer. Trust me, it's hard to get through engineering school. Let's be honest there. It's not hard to be an engineer. If you make it through school, the job is not that hard. The job's pretty easy. It's a fun job. It's problem solving. Your job is to find out why things happen with the best evidence that's available. Jay, all my engineer brothers and sisters here, right? Engineering jobs was pretty simple. It was fun, and it was challenging because you had to solve a problem with available evidence. You had to build your problem and solve it, which that's actually really fun. Because it's not really somebody comes up and says, hey, here's the problem, here's what you need to do, just do it. It's like, hey, shit's happening, go figure it out. It wasn't hard because if you're able to get through school, you're the kind of person that excels at that particular skill set. Like, you know, I couldn't like ballet dance to save my life, right? I don't have those skills. But solving problems, I guess that's a skill I had. And you're good at piecing together information, looking at data, seeing what correlates, what doesn't, and you're just math on the surface. It's not hard math. It's just easy to see things that go together. Isolate two variables, compare them. Okay, they correlate. That's your job. Do that a million times over, you found your problem. But in school was hard because you're learning complex math and all that stuff, and it just was designed to weed people out and so you could solve problems. And so, like, you know, as an engineer, a trader is more like an astronaut than an engineer. An astronaut is an engineer that works in space under like constant pressure of death. A little bit more scary of a job. Well, you're kind of an astronaut as a trader. You have to be able to solve problems in face of like constant danger, right? You can literally lose everything you have at this casino. So you can get hit by a fucking rock in space that could smash your visor, and you can die for random reasons. Scary. And trading's kind of like that. Knowing when stuff is random, it's dangerous. That's what we excel at. I'll tell you, it's dangerous. These purple bands, if you're shorting beyond these purple bands, you know, we know it's dangerous. Irrational means don't trade. Irrational means don't trade. That's my rule. If you held short and you're inside these bands, you're going to blow up today. Good luck. That's what irrational is. You're seeing it for your very eyes. QQ hit a yellow line. It's resistance right now. 12,389. The point I'm saying is solving problems was my job. Seeing patterns was my job, but not chart patterns, not silly stuff, but the patterns in behavior. Like every time I push this button, this thing happened. That's the kind of stuff. How much longer of this do you think we got? It's indeterminable. That's the point. I can determine that I have no idea. See, the idea is that in these purple bands, I stopped trying to guess. Why would I? Like, indeterminable, right? I don't know. I know that I don't know. As a matter of fact, in this purple band, I'm 100% confident. This is the one certainty in trading. Now, I'm going to tell you, I do have a crystal ball. I have been cheating. I do have something that works every single time. You guys want to know what it is? It's true. It's very rare someone can claim. As a matter of fact, it's almost impossible. I have something that's never wrong in the stock market. You want to know what it is? Is that at this particular spot in time, I'm 100% confident. They have no fucking clue what's going to happen next. Guaranteed I have no clue what's going to happen next. Learn it. I'm out of here. Somebody asked me, how much longer do you think we got? You're over trading. Don't even ask that question. Okay? Don't even consider trying to figure out how much longer we got. We're in the last 2 hours of the day ramping up on options expiration. It's going to be random. We're outside DD band. I don't know. But past here, I'm 100% sure that I got no idea. That is a guarantee. It's mathematically indeterminable. It is random, random, random. It'll travel backwards in time. It'll open a wormhole. It'll go up. It'll go down. Don't know. Try to run a back test. What happens when irrational markets take off? You don't know, and you can't know. That's the thing. We're squeezing people into options expiration on a really bullish catalyst, right? This could happen. This could happen. This could happen. Anything could happen. It's 100% indeterminable. So don't even try to figure it out. As a matter of fact, sometimes I've seen price go backwards in time. I'm kidding. I'm lying. That's a lie. That never happens. Jokes aside, I'm outie. Love y'all. Thanks for tuning in. Go to Rock Scooter Discord. We'll see y'all tomorrow. Tired. My throat hurts. It's cold. It's like a grumpy old man. Hedge pressure. Resilience, liquidity maps. We got all the good stuff here. When not to trade. You ready to learn when not to trade when markets are crazy? How can you have indicators telling you markets are crazy? Turn everything off. We do. Risk management is our focus. We built something that's risk management for traders. No technical indicators anymore. No chart patterns. No multi-time frame confluence. That's another word for scam. Don't buy into crap made in the 60s and 70s. Can't get out your crayons, draw circles, rectangles, trapezoids, octagons on your chart with 1,000 different time frames to try to predict the stock market. Nobody can predict the stock market, but I can predict that I have no idea when things are going to happen sometimes, and I know just to sit out. That's the power that has me on 100% win rate so far on my small account challenge in 5 days. Doesn't mean I'm great at trading, just means I'm picky when I trade. We'll teach you how to be picky. We love you guys. We'll see y'all tomorrow. Discord will be posted right here in chat and also link in the description below. Join us and check out Rock's Gear for free. Love you guys. See y'all tomorrow.